in case it's different from the one we are using now, kindly visit that group, that link, to be sure that nobody is there. We don't want anybody to miss out of what we are going to do now. Okay,
right,
let me start by saying good morning to everyone. Good morning, good afternoon, wherever, or good evening, depending on where you are joining from. Let me say you are all welcome to Ivy League, and you are welcome to this last revision for Ivy League, which we have decided to make available not only to our current students, but also to the ACC students who are writing this paper across the globe. We just decided to do this to ensure that at least not only our students are able to benefit from what we are doing today, but also we give access to others who are not our students to equally benefit from this as well. So we are all welcome. I just want to before we start, I would like to set some basic rules that we need to follow. The first thing is that let's make sure that we put up our video. I think someone is TH is not putting up the video. Kindly put off your video. So let's try as much as possible to put up the video so that it will not serve as a source or cause of distraction to us. So make sure you put off your video. Then make sure you put yourself on mute. Make sure you go on mute at every point in time.
Hello, Jeremy, you are mute, please, if you can hear me.
Okay, sorry, someone put me on mute. Make sure you go on mute. Everybody should go on mute. In case you need to talk, make sure that you raise your hand. I will see you and I will call upon you to speak or ask.
So Jamu, you're on mute, if you can hear us.
They keep on putting me on mute. I don't know who is doing that. Please, can you stop putting me on mute?
Lecturer, thank you.
Oh, sorry. So
Ifeoluwa, your hand is up.
Yeah. So I'm trying to. Can you hear?
We can hear you, but your voice is not loud enough.
Okay. So I think whoever is the organizer needs to put everybody as a participant so that they cannot mute everybody. I think that's why you keep getting muted. If anybody clicks on mute or you get muted. So they need to make everybody just an attendee while the organizers are presenters. So those are the only people who will be able to mute everybody or do what or change all those kind of settings.
Okay, thank you for that. I'm sure the admin can hear that, but I wouldn't know if that is done. Everybody be able to speak and ask questions when the time comes.
Yes, they will be able to do that if they're just attendees. They can ask questions, they can raise their hand, they can talk, but they won't be able to, number one, invite other people. They won't be able to mute participants except people mute themselves, or the presenters mute every other person.
Thank you for that. So admin, please take note of that. Ifeoluwa, your hand is still up.
I've lowered it. Sorry. Thank you.
Okay. I say Let me just repeat the rules I've mentioned before. So do not use your video. It could cause distraction to us, and it could also affect your own network. You may not be able to hear us well. So don't show yourself, don't show your face, don't show your video. Number two, let everybody remain on mute. If you want to ask questions, just raise your hand. I will see you, I will call upon you to ask your question, and you'll be asked to speak. And once you speak, please lower your hand so that I won't think you still want to say another thing, whereas is the initial hand that you raised that I'm still seeing. Having said that, we would like to start now. So we're all welcome to Ivy League. This is the last revision day that we are doing. And this is the only one that we've made available to all ACC students across the globe. Let me quickly, in a few minutes, go through two important documents that I'm sure we are all familiar with. The first one is the syllabus that shows everything that we're supposed to cover. And the syllabus I'm talking about is the one that covers September 2020 up to June 2021 exam. As you can see, the syllabus shows it shows a number of things, including the structure of the ACC qualification generally. That is not where I'm going. It shows the guide to ACC examination structure and delivery mode. I'm sure we have read this. It shows the guide to the ACC examination assessment, which I want to believe we've all read. The relational diagram linking financial reporting with other exams, you can see that. It's showing that below the financial reporting, you've got financial accounting. So the expectation is everyone who is writing this paper will have actually done financial accounting. And if ACC has exempted you from this, please go on mute. Someone is not on mute. If ACC has exempted you from financial accounting, it's simply because you have done a paper either in another professional examination or in your school, and that is what has made ACCA to exempt you. Aside from that, you should have done financial accounting because the knowledge of financial accounting is highly required for you to excel in financial reporting. And also you could see on the right, you have audit and assurance. On the left, you have corporate and business law, telling you that these papers are equally relevant and linked one way or the other to financial reporting. Then after you are done with financial reporting, you are going to proceed to do some papers which are core. Those two papers you see there, the strategic business reporting and strategic business leaders, they are core papers that you have to write after leaving this. In terms of the structure of the examination, you will have section A of the computer-based exam, which will comprise 15 objective test questions of 2 marks each, 2 marks each. That will be 30 marks in all. We are going to have section B, which is going to be the computer-based examination, and it will consist of 3 questions. And each one of the 3 questions or the 3 scenarios will contain 5 objective test questions, such that in this section B, you are going to have 15 questions in all, and each one of them will carry 2 marks each. And that is another 30 marks. So 30 marks in section A, 30 marks in section B, you are going to have 60 marks. Then we go to section C. That will consist of 2 questions. It's going to be a practice question kind of, which typically border on specific area of the syllabus. As we can see, that the main capabilities of the syllabus are these. There are just four main capabilities that we can see there. You have the conceptual and regulatory framework for financial reporting. That talks to the conceptual framework of the IASB that was issued in 2018, which became effective in 2020. Then you have the accounting for transactions in financial statements. All accounting standards are under this place, with the exception of accounting standards that relate to group accounts, which you may see under preparation of financial statement. Then you have analysis and interpretation of financial statement. So that is, and preparation of financial statements, we look at financial statement for a single entity. That will require your understanding of all accounting standards that are examinable in this paper. Then another set of financial statement you need to learn how to prepare is financial statement for a group of company. And that is where IFRS 3 business combination, IFRS 10 consolidated financial statement, and IAS 28 investment in associate and joint venture. That is where they become very relevant. So that is basically, and in terms of what you have under each one of them, you have them in the remaining part of the syllabus here, well broken down. I don't want to go into the detail of this, so I want to believe you all have access to this document and you can read, in case you have not read the document. So having said that, I will also show you now what we call examinable document. Examinable document. The examinable documents equally is for the very June that it covers up to June that you are writing. And as you can see, what ACC has done here is you can see that you have a column for FR and you have a column for XBR. And you begin to look at it one after the other, which accounting standard is examinable in FR. The expectation is that before you step your leg into the exam hall, you must have covered all the examinable documents that have been highlighted here for financial reporting. You can see IAS 1, presentation of financial statement, IAS 2, IAS 7, IAS 8, IAS 10, IAS 16, all of them are relevant to FR. IAS 19 is not relevant, so you should not have been taught IAS 19. IAS 20 is relevant, 21 is relevant, 23 is relevant, 24 is not relevant for your level, 27 is relevant, 28 relevant for FR, 32, 33. 34 is not relevant to you, 36 is relevant, 37, 38, 40, 41, and IAS 1. Sorry, I41. IFRS 1 is not relevant to FR. Likewise, IFRS 2, IFRS 3, business combination, relevant to you. IFRS 5, IFRS 7 is a disclosure standard. It's not likely to be examined as such because it's just a disclosure standard when it comes to financial instrument. IFRS 8 is not relevant. 9 is relevant, that is financial instrument. IFRS 10 consolidated financial statement relevant. 11 and 12 not relevant to you. 13 is relevant, even though it will not be examined in detail. Perhaps it's just the basic part of it, talking about the definition of fair value, maybe the framework at the highest level. IFRS 15 revenue relevant, IFRS 16 relevant. Then you have the conceptual framework, which is the 2018 conceptual framework. For our students, you have this well covered in the handout, which can be read to the extent that you need it. So those are the relevant papers, and those are the relevant documents that everyone who is writing this FR needs to be conversant with before you step your leg into the examination hall. Before we continue, if you look at what are we going to cover today, there are actually two of us that we handle today's class. I'm going to cover the first half, and specifically I will be focusing on just few areas, given that 4 hours will never be enough to cover everything that we have done in this FR. I will only focus on specific areas within that 4 hours that I'm going to spend. There will be break in between, but just to ensure that we all keep on standing up. I know students, those of you receiving this revision class may be standing up, but for me to keep on talking, we may break our break, which will have been 30 minutes. We can break it down into maybe multiple time. We can do 15 minutes at different intervals just to be sure that everybody is standing up. I'm sure we will have heard that medically it's not advisable to sit down for too long, and so we can break it down into multiple breaks. So my focus this morning is going to be on IS1, financial statement for a single entity. How do you prepare financial statement for a single entity? And that we cover, IS1 covers all the elements of financial statement. But the only one I will not cover this morning as part of my own is the statement of cash flows, because that is covered in another accounting standard, which is IAS 7. So I will be focusing on IAS 1 with regards to other statements, notably statement of profit or loss and other comprehensive income, statement of financial position, and statement of changes in equity. When we are solving the question, unfortunately, we may not see all these statements in the question I'm going to solve. Because the focus of this class is to briefly explain what we need to know under the standards that I'm supposed to cover, then I will go straight to solve question. I may not really go deep down into showing you the formats of everything that we have under IS1. I'm going to cover group account as well. I'll briefly explain what you need to know as far as group account is concerned. Then after that, we go straight to solve a question. I hope time will permit us to do that. I'll solve a question under IS1. I will solve a question under group account. Then there are about 2 or 3 standards I need to equally cover. That talks to 1, financial instruments, which consists of IAS 32, IFRS 9, and IFRS 7. So I will cover that. I will look at some objective test question there. Also, I will cover IAS 10, which is events after reporting period. We're going to look at some questions to be able to confirm our understanding. Thereafter, I will move to the last one, which is IAS 8, accounting policies, changes in accounting estimates, and error. So basically, those are the things I will cover this morning for the first half of the class. Having said that, let me go straight to IS1. IS1 deals with preparation of financial statements. It has a number of topics or principles that we need to know about financial statements we are preparing. Aside from that, IS1 lists the components of financial statements, components of general purpose financial statements, which include 1, statement of profit or loss and other comprehensive income, 2, statement of financial position, 3, statement of changes in equity, 4, statement of cash flows, which I said I will not handle this morning. Then you have the last one, which is notes, comprising significant accounting policies and other explanatory notes. In the ACC examination, we don't really look at that type of notes that you will have had in a typical published financial statement. However, when you are asked to prepare financial statement, the examiner expects you to show the working notes. Yes, those are working notes, but not the real note that we publish as part of financial statement. IS1 gives us the format of each of these statements. It gives us the format. And for all of them, you know, statement of profit or loss, another comprehensive income is a 2-in-1 statement. The P or L part start from revenue, cost of sale, distribution costs, admin expenses, and it ends in profit for the year. It ends in profit for the year. Then after profit for the year, you have other comprehensive income. The other comprehensive income could have up to 8 or 9 items, according to IS1. But for the purpose of FR, financial reporting, you are only expected to know just 2 of those 8 or 9 items that typically you will have under other comprehensive income. The 2 you are expected to know are 1, revaluation gain or loss on PPE, property, plant, and equipment under IAS 16, or under intangible assets under IAS 38. You know, under those 2 standards, you can use cost model, you can use revaluation model. If you use revaluation model, initial revaluation gain will be recognized in OCI, and from there it goes to revaluation reserve in the statement of changes in equity, and from there it goes to statement of financial position. So, but if it's a loss should go to P or L unless it reverses the previous revaluation gain that you have in revaluation reserve, and to that extent, you pass it through other comprehensive income as well. So you are expected to know that as one of the 2 items under other comprehensive income. The second one is under financial instrument, IFRS 9, you know, investment in equity can be fair value through P or L or fair value through other comprehensive income. Fair value through other comprehensive income means at the end of every reporting period, you carry it at fair value. Fair value gain or loss that you have, you will recognize it in other comprehensive income. So that is the second item you are expected to know when it comes to the OCI section of the statement of profit or loss and other comprehensive income. When it comes to statement of financial position, you have 3 sections. You have the assets, you have the liabilities, and you have the equity. Under assets, assets are usually grouped into current and non-current. Current and non-current, except you are dealing with entities that use liquidity basis, which are typically banks. But for the purpose of the ACC examination, ACC will not examine a question where the format being used is actually based on liquidity basis like banks. So ACC will always examine questions where the assets will be segregated into those 2 groups, current and non-current. Typical items under non-current include property, plant, and equipment, intangible asset, investment in associates. The under current, you have inventory, you have trade receivable, you have cash and banks. typically those are the items you have. Martina, your hand is up. Please go ahead.
Yes, hi, Mr. Jami. So regarding that, when I was checking through my text, I saw that it is required that we arrange the non-current asset, the current assets in order of liquidity. Is that how it should be, or if we arrange it anyhow, the current assets, are we still going to be giving our marks, or do we need to know the arrangement of current assets based on their liquidity?
Are you asking a question pertaining to an entity that is arranging all the items under asset and liability in order of liquidity, or you are talking of an entity that segregates the assets and liability into current and non-current?
So I don't understand your question, but when I was reading my text, it says that even when we segregate
Ivy League
BPP,
study test or
no,
what?
BPP, that when we
Okay,
are arranging assets,
let me tell you.
okay,
Let me tell you. So that I don't know what is contained in BPP, but I'm telling you what is contained in IS1 and what you need to know,
okay,
and what the examiner expects you to know. I've told you examiner will not examine questions where the assets and liabilities are arranged in order of liquidity, like banks. No. Now, SCCA will examine you based on the understanding that assets and liabilities will be segregated into current and non-current. And when you start under non-current, you start with the most permanent and you end with the least permanent asset, right? When you start with current, you start with the least liquid asset and you end with the most liquid asset. I will say that again. When you are doing current, you start with the least liquid asset and you end with the most liquid asset. Applying that principle that I've just mentioned now, it means when you are arranging current, you have inventory, you have trade receivable, you have cash and bank. The least liquid of them is inventory. That should come first. Then followed by trade receivable. Then the most liquid of them all is cash and bank. And that is the one that should come last. I hope that is understood.
yes, sir. Okay, thank you.
Okay, the liabilities too are meant to be arranged, segregated into current and non-current. The most permanent comes first. Under non-current, typically you can have, what is it called? You can have maybe 10% loan note if you have. You can have deferred tax liabilities. You can also have contract liabilities that is not meant to come in within the next 1 year. The undercurrent typically will start from trade payable, you have current tax payable, and then you have the rest of them. So that is about that. In the equity section, we don't segregate into current and non-current. Typically, you start with share capital. If there's share premium, you put it there, and you put the other reserve, such as revaluation reserve, retained earning. And you know all these items under equity are in the statement of changes in equity. You will have a column for each one of them. You will have a column for each one of them. Statement of changes in equity is just a reconciliation statement, put it that way, where you will start with balance at the beginning of the year. Then what is coming through P or L in terms of profit for the year, you bring it in, and you will include the amount under retained earning column. Then what is coming from other comprehensive income, if you have revaluation going there, it will come in that place, and you will put the amount under revaluation reserve. If you have fair value reserve in relation to find equity instrument at fair value through OCI, you can also have that one there, and also put that column there as well. Then if you have dividend paid during the year, you will put in the statement of changes in equity or under the column of retained earning. Under the column of retained earning. There could be transfer between revaluation reserve and retained earning according to IAS 16. If you have that, just move the amount from the column of revaluation reserve. So it will be in brackets, which means minus under revaluation reserve, then you put it under retained earning. So that is what you do. Other than that, IAS 1 talks about current versus non-current. So I want to believe all of you have the test that you read. IAS 1 tells you that an asset should be shown as current if it meets about if it fall into any of the 4 categories. So it now say any other asset other than those ones that fall in those 4 categories will be seen as what? Non-current asset. Then the same thing it tells you about liability. It says a liability is seen as non-current if it falls into any of the 4 categories. One of the 4 category under asset is expected to be realized within the entity's operating cycle. Another one is expected to be but under liability, you have something similar under the 4 categories. One is expected to be settled within the next 12 months after the end of the reporting period. So those are current liabilities. We have 4 categories. It now says a liability that does not fall into any of those 4 categories should be presented as what? Non-current. Non-current. And IAS 1 specifically mentions that deferred tax should never be presented as current, no matter what. So deferred tax could be an asset, it could be a liability. If it's a liability, you present it under non-current. If it is an asset, you present it under non-current as well. Typically, as far as IAS 1 is concerned, those are the things I would like to mention. Before we go ahead to attempt a question. At this point, I would like to ask if there are questions for me that you want me to deal with before I go ahead. And look at the question that has been sent to you all. If you have a question that has been shared with all of you, right? If you have any question, raise your hand and ask. Otherwise, then we'll go to the mode of solving question now. Okay. If there is no question, I would like someone to help in reading the question you have in this handout. Sorry, in the question bank that has been sent to you. The first question there.
Okay, I'll read, sir. Question 1. After preparing a draft statement of profit or loss before interest and tax. Okay, let me read the requirements first. Okay, required. Prepare a schedule of adjustments required to the draft profit or loss, draft profit before interest and tax in the above trial balance to give the profit or loss of Triage Co. for the year ended 31 March 20x6 as a result of the information in notes 1 to 4. B. Prepare the statement of financial position of Triage Co. as at 31 March 20x6. And C. The issue of convertible loan notes can potentially dilute the basic earnings per share. Calculate the diluted earnings per share for Triage Co. for the year ended 31 March 20x6. There's no need to calculate the basic earnings per share. After preparing a draft statement of profit or loss before interest and tax for the year ended 31 March 20x6, before any adjustments which may be required by note 1 to 4 below, the summarized trial balance for Triage Co. as at 31 March 20x6 is as follows. So we have equity shares, retained earnings, draft profit, 6% convertible loan notes, leased property, plant and equipment at cost, amortization, depreciation, trade receivables, other current assets, current liabilities, deferred tax, interest payments, and current tax. The following notes are relevant. 1. Charge Co issued $400,000, $100, 6% convertible loan notes on 1st April 20x5. Interest is payable annually in arrears on 31 March each year. The loans can be converted to equity shares on the basis of 20 shares for each $100 loan note on 31 March 20x8 or redeemed at par for cash on the same date. An equivalent loan note. Okay.
Sorry, Martina. Which question are you reading?
The first question, preparation of financial statement for a single entity.
The name of the company is Triage, right?
Yes.
Okay. Okay. Continue.
Am I reading the correct one?
No, continue. I'm just trying to figure out where you are. And
okay, I'm on note 1.
Okay, okay.
An equivalent loan note without the conversion rights would have required an interest rate of 8%. The present value of $1 receivable at the end of each year, based on discount rate of 6% and 8%, as follows. 2. Non-current assets. The directors decided to revalue the leased property at $66.3 million on 1st October 20x5. Triage Co does not make an annual transfer from the revaluation surplus to retained earnings to reflect the realization of the revaluation gain. However, the revaluation will give rise to a deferred tax liability at the company's tax rate of 20%. The leased property is depreciated on a straight-line basis and plant and equipment at 15% per annum using the reducing balance method. No depreciation has yet been charged on any non-current assets for the year ended 31 March 20x6. Note 3. In September 20x5, the directors of Triage Co discovered a fraud. In total, $700,000, which had been included as receivables in the above trial balance, had been stolen by an employee. $450,000 of this related to the year ended 31 March 20x5, the rest to the current year. The directors are hopeful that 50% of the losses can be recovered from the company's insurers. Note 4. A provision of $2.7 million is required for current income tax on the profit of the year to 31 March 20x6. The balance on current tax in the trial balance is the under or over provision of tax for the previous year. In addition to the temporary differences relating to the information in Note 2, at 31 March 20x6, the carrying amount of Triage Co's net assets are $12 million more than their tax base. I'm done, sir.
Okay, you are done, right?
Yes, sir.
Thank you very much. I would like to say a few things before we go ahead and solve the question. And what are those things I would like to say? First, preparation of financial statement for a single entity, which is the question we are seeing here, is the structure of the question you are likely to see in the exam. The two practice questions that we carry 20 marks each, they will border on, it could be like this, which is preparation of financial statement for a single entity, because this is actually a past ACCA question for this level, and based on the type of structure that you guys of the exam that you are doing now. You can also see a question that is on group accounts, financial preparation of group financial statement. That is the second thing you can see there. You can also see a question on the statement of cash flows. absolute statement of cash flows. You can also see a question on interpretation of financial statements. So in terms of those two practice questions that carry 40 marks, 40 marks in all, yes, 2 questions. So the main focus is going to be preparation of financial statement for a single entity like the one we have seen here. 2, statement of cash flows. 3, interpretation of financial statement, which some people call ratio analysis. And number 4, group financial statements. Group financial statement. So those are the 4. Now, the one we are dealing with here or tackling here now is a financial statement for a single entity. Fortunately, unfortunately, or surprisingly, unlike group accounts, where you don't need to know what is contained in every other accounting standard, with the exception of the group-related accounting standard, such as IFRS 3, IFRS 10, because those are the underlying standards that really govern how financial statement, consolidated financial statement should be prepared. And also IAS 28, in case you are dealing with an associate. You don't need to know any other accounting standards. The only one that I've seen in the examiner really test at this level before in group account, IFRS 9, when it will tell you that fair value through P or health financial asset at the beginning is a figure, there at the end is a figure. Otherwise, everything is actually based on those group accounting standards. Now, aside from that, when it comes to preparation of financial statement for a single entity like the one we're about to solve, it requires you to have the knowledge of every other accounting standard. It does what? It requires you to have the knowledge of every other accounting standard, with the exception of the group accounting standards. So, you need to have the knowledge of IS 1, you need to have the knowledge of IS 2, you need to have the knowledge of IS 10, you need to have the knowledge of IS 8, you need to have the knowledge of those standards because any of them could be examined. Any of them could be examined here. But oftentimes, there are some that will always be examined in this type of question. There are about 2 that will always be examined from experience. Those are 1, IS 16, property, plant, and equipment, and 2, IS 12, income taxes. Experience has shown that those 2 will always be examined. Those 2 will always be what? Examined. So what we are going to do now is I'm going to share the Excel. Again, let me remind everyone that I strongly believe that at this level, we are all familiar with the computer-based platform of the ACCA, which is the platform you are using for the examination. In solving a question of this nature, you are going to use spreadsheets, but which is slightly different from Excel. Slightly different from Microsoft Excel because in this Excel I'm going to use now, I can create rows, I can create columns. But the one you are going to use in the exam, there will be no room for you to create row and column. And what that talks to is that leave enough space so that you won't have to scatter your work at the end of the day if the need arises for you to create additional row. Although I think you can copy and paste, you can cut and paste, but you won't be able to create additional rows, and unless they've changed that now, because when I used it, not to write exam, but when they first introduced it, we were asked as tutors to get ourselves familiar with it, and that was where I saw it. Okay, having said that, I'm going to share the Excel with you right away. which is what we will use to solve this question. I strongly believe you can all see my exam. The requirements in this question are three. The first one says we should prepare a schedule of adjustments required to the draft profit before interest and tax in the above trial balance to give the profit or loss of Triage Co. for the year ended 31 March 2026 as a result of the information in notes 1 to 4 above. Okay, before I continue, Vera, your hand is up. Can you go ahead and speak? Vera, go ahead and speak. Your hand is up. Unmute yourself and speak. You are still on mute. Vera?
Yeah, good morning, sir.
Good morning.
I wasn't seeing your screen before, but I'm seeing it now.
Okay, that is fine. Then you can lower your hand.
Okay.
So if you look at that requirement, it says, if you look at the trial balance given to us, it means they have prepared statement of P or L. They have already prepared statement of profit or loss. That is what we can see. That is what we can deduce here. And if you go back to the trial balance, the third item there says draft profit before interest and tax for the year ended 31st March 2026. On the credit, you see how much? 30,000, right? You see 30,000. And what that is telling you is that, and you can see retain earning at the beginning of the year separately, 35, right? 35. And again, we were told at the beginning of the question that after preparing a draft statement of P or L, before interest and tax, so they've not taken cognizance of interest and tax for the year ended 31st March 2026, before any adjustment which may be required by note 1 to 4. The summarized trial balance is as given as at 31st March 2026, which is the reporting date here. If you look at it, we were given retain at the beginning of the year. The beginning of the year is 1st April 20x5, 35 on the credit as well. Then you have the draft profit before interest and tax. So what we are being asked to do in requirement A is the draft profit before interest and tax of 30 has not taken cognizance of information in note 1 to 4, and we need to take that into consideration. So I'm going to do exactly what the man is asking me to do, which is, I will say A. I'll put the name of the company there, Triage Co. Schedule of what? Adjustments to profit for the year ended 31 March 20x6. Yes, that is the first thing we are asked to do. That is the first thing we are asked to do. And we are supposed to start with what? With that profit of 30. We are supposed to start with that profit of what? 30. So I will say draft. I want to call it the name they call it in the question, in the TB, which is what? Draft profit before interest and tax for the year ended 31 March 20X6 per TB. That is per the information in the TB. All the figures are in thousand. I would like to put that on top here. And the figure, okay, I'm just maintaining 2 columns. It's not compulsory. You can use only 1 column. I would say 30 million. Yes. Then the best thing we should do is leave enough line. We don't know how many lines we need. But you can leave like 8. If you don't use the 8, nobody will penalize you. 1, 2, 3, 4, 5, 6, 7, 8. In the exam, you may leave up to 10 because you don't know how many adjustments you are going to have. So let me sum up. So that as I'm getting each of the adjustment, I'm bringing it straight here. I'm bringing it straight here. You just have to be smart for the examiner. Those who pass this paper are the smartest one. Once you are smart, you pass. But those who score above 90%, they are smart and they know it very well. So there are 2 different things. If you want to pass, you just have to be smart for the examiner. However, if you want to now score above 90%, which we've been able to achieve in Ivy League before, we've achieved some of our students scoring 92%, 95%. Sorry, 92, 95, yeah. I'm still looking for someone to achieve 100 for us this time around. So for you to score more than 90, I'm sure you need to not just be, you must be smart, but you equally need to know everything. So B, what are we asked to do in B? It's better you equally set the template for that right from inception. B says, prepare the statement of financial position of Triage Co. as at 31st March 20X6. Okay. So I'm going to say Triage Co. again. Okay, let me just borrow from here to get the heading. Triad Co. That is statement of financial position. Statement of financial position as at 31 March 20X6. Yes, that is the second requirement. Let me borrow from here as well and paste here. I'm sure under that we're going to have assets. We're going to have assets. Under the assets, what type of asset are we likely to have? I'm sure we have property, plant, and equipment. And we have property, plant, and equipment in the TB. So I'm going to just say property, plant, and equipment. Property, plant, and equipment. We are not sure of what else we have. You can leave a line. Okay? Leave a line. If you look at the way TB is given, we have.
So shouldn't we have it as non-current assets before having property, plant, and equipment?
Okay, thank you. You are right. So what you are saying is non-current assets. Then under that, we are going to have current assets. So leave like 2 lines because we are not sure of whether something else will come in, unless you are so certain from the notes you have read. note 1 to 4. Then you say current assets. Current assets. Under current assets, I'm sure we are in the TB. If you look at the TB closely, where you see something like trade receivable, right? And aside from that, you see other current assets, right? So that means trade receivable will be separate. Then every other, you have trade receivable, trade receivables, and you have other current assets. Then, of course, you can leave like 2 lines, and at the end of the day, you are going to get a total. So that will be the total of the asset side. Let me paint that in green because it must equal the. Then you come down and start with equity. Equity. For me, your hand is up. Go ahead.
Yes, we've lost your screen. I think someone shared their screen and now we've lost your screen.
Hey, we are violating the rule. How can someone be sharing screen here? I want to believe someone did
back
that
now.
unknowingly. Thank you.
Thank you.
So we have equity. Okay, so it's supposed to be equity and liability. Then under that we have equity. Then under that we have equity share capital. Isn't that what they call it in the question? They call it equity share of capital. Yes. We are not sure whether there will be other components of equity. We are not sure whether there will be any other reserve. So the first thing is under equity, we have equity share capital. If the other reserve, they should come in before retained earning. They should come in before retained earning. But I will put retained earning here and leave like 2 or 3 other lines. And it's mainly because here I can easily create row, but for the purpose of the exam, you may not be able to do that. But if I later discover that another reserve would come in, I will bring retained earning down and bring those other reserves up after equity share capital.
So for our own exam, sir, after we have share capital, we should leave like 2 lines, then put retained earnings.
Yes, you can do that. Okay. But you know, you can. I want to believe you can cut, and so even if you put retained earnings after equity share, the way I've done my own, if later you discover that through the notes that other reserve will come in, then you can just cut your retained earning that you've written there and paste it down and bring those other ones in between. So then let's move to non-current liabilities, right? Non-current liabilities. Non-current liabilities. Under that, what do we think is very obvious from the TB? I can see 6% convertible loan note.
Deferred tax.
Deferred tax. I'm looking. Yeah, I can see deferred tax. It's a liability there, right? But remember that it may be a liability in the TB. What you likely have in the TB is the deferred tax at the beginning of the year. We just have to be sure that at the end, but I will write it here. I've left enough like in case it turns out to be an asset. So I will say deferred tax liability. Deferred tax liability. Then we have 6% 6% convertible loan note, right? If you are not sure of whether something else will come in, you may want to leave a line or 2 lines, right? You may want to leave a line or 2 lines. Then we come to current assets. Current assets.
Liabilities, sir.
Sorry, slip of not just slip of tongue and slip of hand. Current liability. Okay, under that, are they equally broken down just like that of current assets? Can we see anything called trade payable? No, I can't see payable. All I can see here is current. Okay, I can see current liabilities and I can see current tax. The current tax we are seeing here, of course, it has a note. It's on the debit. That is likely to be under provision for prior year. But I think the best thing is we'll say current liabilities, the way I've done it, and let's assume that we will have current tax payable until we are told otherwise, until we discover otherwise. Let us assume that there will be current tax payable until we check the note and we discover that is not the case. Okay. And I think after that, then you can have the total of equity and what? Liabilities. So let me put the total here. You know, because we are doing this thing together. If I were to do it alone, perhaps we'll have done half of this thing now. So, but doing it together could take time, which is exactly what you are saying. Okay, so I think we have set up the template for the solution. The C. Okay, we have to calculate diluted EPS, right? Diluted EPS. Let me just put that one here as well. C. So diluted EPS. EPS is earnings per share. That is what we have to do here. So I'm going to just leave enough space there in case I need to show the working. I will leave enough space. Then I now want to have working notes to support what we want to do. Okay, and for this our working note, I'm going to start with note 1. You know, it's note 1 to 4 that we will need to be able to make the adjustment to the financial statement. So note 1 says, triangle. We all have the question, I believe. Triangle issue $400,000, $100, 6% convertible loan notes on 1st April 20X5. 1st April 20X5. The reporting day is 31st March 20X6, which means it was issued at the beginning of the year, right? It was issued at the beginning of the year. It's convertible. And I'm sure your mind will be going straight to financial instruments now. IS-32. Interest is paid annually in arrears on 31 March each year. Okay. The loan can be converted into equity shares on the basis of 20 shares for each $100 loan note. 20 shares for each $100 loan note on 31st March 20X8. Okay. Or redeemed at par for cash on the same date. An equivalent loan without the conversion rights will have required an interest rate of what? 8%. Fantastic. The present value of $1 receivable at the end of each year based on discount rates of 6% and 8% are as given there. So it is the knowledge of IS-32 financial instrument that is being tested here. You know, I've told you any standard could be examined in this type of question. Any standard could be examined. So it is IS-32 now. You know from your understanding of IS-32 financial instrument that when you have a convertible loan note, convertible preference shares, or convertible debenture, whatever name they call it, as long as it is convertible. Convertible means the holders, the investors, they've got the right at specific dates in the future to convert that thing to the ordinary share of the company that issues the convertible. So they are at liberty. They have the discretion to opt to convert or not to convert. They can go for redemption, whichever pays them. Whichever pays them. However, when you issue such an instrument as a company, and two criteria are met. One, it is issued in the functional currency of the issuer. It is issued in the functional currency of the issuer. I'm sure you learned functional currency under IS-21. But you know that is not apparent in this question. We don't know what the functional currency of triage is, but we are assuming it is what? It is US dollar. So the assumption is that first condition is met. The second condition is from inception, it is already known the number of shares that will be given to each holder when they want to convert. So it is fixed. The number of shares to be given to them once they want to convert is already fixed. As you can see here, it's already fixed. Is that not? Because somewhere in the question it says an equivalent, no. The loan note can be converted to equity shares on the basis of 20 shares for each $100 loan note. So for each $100 loan note, you know the number of shares to be given to them is fixed. So that means the second condition is met. So once those two conditions are met, this type of instrument has what? It has two components. It's what we call compound financial instruments. It has what? Two components. The first one is it has liability component, and the second one is it has equity component. How do we separate it into equity and liability component? That will be the first step in this working note. We call this split accounting. And that should be done on day one when that instrument was issued. Apparently, I'm already revising IS-32 here, which is part of what I'm supposed to do today. So we have working one. And the name of the working is, I will say 6% convertible loan notes, right? So I will group that in, I will say A. The first thing I want to do is the split accounting, which must be done. So I will say split accounting. That is to separate the proceed. What I mean by split accounting is separation of the proceed into equity and liability component. That is what we mean by split accounting. As at what date? We are doing it as at the date it was issued, which I guess according to the question is 4th April 20x5. 1 April 20x5. Fumi, your hand is up. Please go ahead.
So just a quick question. You were mentioning the conditions for the convertible loan. The first condition, it wasn't very clear. You were saying it's meant to be in currency. We need to identify
The condition to say that this instrument contains equity component. The condition to say the convertible contains equity component are two. One, it must be issued in the functional currency of the issuer.
Ah, functional. Okay, thank you, sir.
And you learned functional currency under S21. True or false?
Yes.
Okay, so the split accounting will require me to do a table like this, right? You say yeah. You will have another column that you are going to say cash flow, right? Cash flow. You will have another column that you are going to say discount factor. Which discount rate are we supposed to use? It is not the coupon rate that the instrument carries. The instrument carries 6% rate, right? It is not that coupon rate that we are meant to use. The coupon rate we are supposed to use is the coupon rate on similar instrument without conversion right, which is the 8% they gave to us. So I would say discount factor at what percent? 8%. Yeah, I would say present value. Everyone should go back on mute, please. So this will be in dollar. Let me just borrow from here. So I will borrow from here. Oh. Okay. Remember, this thing has 3-year tenor, 3 years tenor, 3 years tenor. So it was issued on 1st April 20x5. And we are told that the day for them to convert or go for redemption is 31st March 20x8. So if you count 20x6, the end of the first year, 20x7, end of the second year, and 20x8, end of the third year. So I would say year one. Okay, I've put year of the one. That is 31 March 20x6. That is the first year. And so I will just change this to x7. And I will just change this to x8. Yes, those are the 3 years. Now, what are we doing in split accounting? When you are doing split accounting, what you are simply doing is you assume that nobody converts. You do what? You assume that nobody converts. That means you assume that everybody will go for redemption. You assume that if everybody will go for redemption. That is the assumption that normally underlies split accounting. You assume that everybody goes for what? Redemption. If everybody goes for redemption, that is all the bond holders, they will go for redemption. That means in year one, at the end of year one, you will pay them because we are told this thing is being paid in arrears, which means it's paid at the end of every year. What is the proceed? The proceed is 400,000, right? 400,000. Oh, it's not 400,000. No. The number, that is the number, 400,000 units. That is the number.
400.
So if you want to know the value, you multiply 400,000 by 100. $100 is the value of each one, is the per value, the nominal value. $100 times what? Times 400. What will that give to us?
40 million.
40 million. And I'm sure you can see that 40 million in the TB. On the credit side, the fourth item, 6% convertible loan note, 40 million. You can see it. So the proceed there is 40 million. So this company at the end of year one will pay 6%. It will pay 6%. So I will say 40 million multiplied by 6%. That is what it will pay in year one. That is what we pay in year one. Please raise your hand if you have questions, otherwise go back on mute. In the second year, the company will pay the same, 2.4. In the third year, you know the assumption I told you on the live split accounting is nobody will go for conversion. Everybody will go for redemption. If everybody goes for redemption in year 3, it means you will pay them the interest of 2.4 million. You will also return their money back to them. You will return the principal of 40 million back to them. So in year 3, it's going to be 2.4 plus what? 40 million going back to them, which will be 42,400, right? That is split accounting. Then you come here, discount factor at 8%. The examiner is generous. He has given us the discount factor for 8%. You know, he gave us for 6% as well. But we know that we are not meant to use the one for 6%. So we are not doing the calculation ourselves. He wants us to use 2 decimal places, 0.93. Please don't punch your calculator. Use what the examiner gives you. Don't say you know it, you know how to do it, you want to do it on your own. No. Use what he has given to you. Then you have 0.86. And for the third one, you have 0.79, right? Then we multiply. So when you say this figure, multiply by this. It gives you the figure for year 1, right? So I will just drag. That is the beauty of using spreadsheet. Once I drag down, it tells me to do it for the remaining year. Then I can sum up. When I sum up here, what do I have? I have 37,792. What do I call that? That is the liability component. That is the PV. The PV is the same thing as fair value of the liability component. That is the fair value of the liability component. Busayo, your hand is up. Please go ahead.
Sorry to drag you back. My network went off for a moment. Please, how did you get the 400?
How did I get?
How did you get the 4,400 in year 3?
This is my console. I'll see the formula here. In year 3, if nobody converts, you pay them the interest of 2.4 and you will return the principal back to them, which is 40 million. So the total cash outflows for year 3 will be 42,400. Is that clear? Is that clear?
Yes.
And lower your hand. Then we know that the proceed that we receive today, the proceed is 40 million. Today being the date of issue, which is 1st April 2025. The balancing figure is what? Equity component. So definitely this is going to a separate reserve on its own. It's going to what? A separate reserve. So this shows that we have got another reserve that we need to put in our SFP, right? And that is the difference between 40 and 37,792, 2208. That goes separately to reserve. That goes separately to reserve. Are we together? That is split accounting on day 1. If I were you in the exam, what will I do? I will just take away my retained earning from here. You know, I've come back to the solution. I'm taking away my retained earning. I'm putting it down. I'm leaving like 2 lines because I've just established that I have another reserve. Okay, let me show you before what is ideally supposed to be the accounting entry. They did not ask us to do accounting entry, but I want to show you how to do the accounting entry. It's not required in the exam. You know they have 40 million in the 6% loan note. They have 40 million there. But according to this thing that we've done here now, how much should they have on day one in 40% loan notes? Sorry, 6% convertible loan notes. How much should they be having there on day one? It is 37,792. 37,792 that you see here is what they should be having there. But currently they are having 40 million. It means we should debit 6% convertible loan notes. It's not required, the debit and credit is not required. With what? 2208. And we will go and credit it to debt credit equity. But what name do we call it? Call it any name. IFRS 9 just, IS32 just says equity. But I will call it other components of equity, other reserve. That is what I will call it. But call it any name you like. Nobody will penalize you for that. Now it means to end the mark here so that the system will not time me out. You know, I used to say that how will it profit you if you finish all the working notes, but you fail to do the solution? What they are asking us to do is the solution. So let's come to equity and we say other component of equity. Other component of equity. That is working note 1A. So I will link it there straight without wasting time. I will link it there, 2208. Yes. You can see I've linked it there. So I've earned the mark. Whatever mark that is allocated to that, I've earned it. So that is being smart for the examiner. That is what it requires. It requires you to quickly take it there, whatever working note you have obtained. Emmanuel, your hand is up. Please go ahead. Emmanuel, go ahead.
Thank you, sir. Okay, please permit me to seek some clarification on this working note 1. So the way you have done this calculation is very clear and understood. However, I will appreciate if you can just share some insight into why exactly we are doing this. What is the rationale? Okay. What are we trying to achieve by getting a component of the 2208 that we've gotten? We are calling it equity component. I also understand what equity component is, but why are we doing this?
Okay. Again, IS32 deals with financial instrument presentation. IS32 is the one that defines financial instruments. It defines financial instruments as any contract that gives rise to financial assets in the books of one entity and financial liability or equity instruments in the books of the other entity. After defining financial instrument, IS32 now tells us from that definition that financial instrument has 3 components. 1, financial asset. 2, financial liability. 3, equity instrument. You will have learned the definition of financial asset is very broad. Financial asset, financial liabilities, they do not have straightforward definition. According to IS32, they do not have straightforward definition. But one of the things that features in the definition of financial liability is contractual obligation to deliver cash, right? Contractual obligation to deliver cash. If you borrow money from the bank, 40 million, you have obligation to pay interest, right? An obligation to pay principal, right? That means that instrument, that 40 million you borrow is a pure financial liability because you have the obligation to pay cash in form of interest and what principal. If you issue a bond that is not convertible or a loan note that is not convertible, it is 100% liability because you have the obligation to do what? To pay it back. However, when you issue a convertible loan note, you will pay interest. Year 1, 2.4, interest year 2, 2.4, interest year 3, 2.4. But at the end of year 3, there are two possibilities for the holders. The holders can say, we don't want your ordinary share. Please pay us our principal back. You will pay them 40 million. The others can also say, no, we don't want our principal back. We are converting it to ordinary share. You know the implication of that? It means you will not return that principal of 40 million to them. What you will rather give to them is what? Is your ordinary shares. That means there are two possibilities at the end of year 3. Do you know today, 1st April 20X5, which one the others will opt for? You don't know. You don't know. You cannot know that today. So that is why the accounting standard says, when you issue a convertible, where the others have the right to convert, there is a calculation you need to do. The shareholders have the right to convert to ordinary share. That right should have a value attached to it, and that right is an equity component. That right is what? An equity component. So that right is what we have valued here as 2208, which is the residual interest. Look at the way IAS 32 defines equity instrument. Can someone define it for me? Equity instrument, the way IAS 32 define it. Of all the 3 components of financial instrument, financial asset, financial liability, and equity instrument, the only one that has straightforward definition is equity instrument. Who knows the definition of equity instrument? Tell me if you know. Tell me if you know.
You see the portion of the financial instrument left after removing the liability portion.
Okay. You are trying to. Okay. You have said it, but indirectly. Look at the way it defines equity instrument. It says is the residual interest. Residual interest in the asset of an entity after deducting all liabilities. Please go back on it. Go back on it. Go back on it. Go back on it, please. So what it means is, if the total asset of an entity is 100, the total liability is 70. The difference between 100 and 70 is the equity. That is what it's telling you. So equity component is the residual. So if the proceed, which is the amount sitting in the cash of the company, you know the company has received 40 million, is sitting there in the asset, which is cash. And we are saying on day 1, the liability is 37,792. The balancing figure, which is the residual, which is the difference between the 40 million cash, the assets, and 37,792, the liability, the balancing, the difference is 2208. That must be equity. And it fits into the definition of what? Equity. So it is IAS 32 that says it, that the right of the bondholder to convert to ordinary share at the end of year 3, a value should be attached to that right. And that is what led us to this split accounting. I don't know whether I've answered your question, Emmanuel. I believe I've answered it.
Absolutely. Absolutely.
Thank you. Okay. We've done split accounting, but the question you need to ask yourself is this. At the end of year 3, if nobody converts, because they have the right to convert and they have the right to go for redemption, if nobody converts, how much is the principal we will pay back to them? How much? Who knows?
40
million. But at the beginning of year 1, how much do we have in the liability? Based on the split accounting we did now.
37.
2232.
87.
And that means you can't wait and not do anything, because systematically this 37792 over the 3 years must be increased to how much? To 40 million, which is what you will pay to them in case they opt for redemption. You must increase it systematically over the 3 years. The process of doing that is similar to unwinding of discount, but that is not the name we call it. We call it subsequent measurement of the financial liability at what, to derive what? Amortized cost using effective interest rate. So I'm going to say B, the B part of that working. So I will say subsequent measurement of 6% convertible loan. You know that is a liability component. Nobody has asked me, this one we put in equity, are we going to subsequently remeasure it? That is a question for you guys. Are we going to subsequently remeasure the component of 2208 that we put in the equity?
No, we are not.
We will never remeasure it. Because we don't remeasure equity. It is only asset and liability we remeasure. We don't remeasure equity. So say subsequent measurement of 6% convertible loan, which is liability component, using what? EIR. What is EIR?
Effective interest rate.
Effective interest rate.
Okay, we call it effective interest method. Okay. But we are supposed, it's only when you remeasure it up to 31st March 2020 XA that you will see that the amount will go back to 40 million. But are we interested in year 20X8 here? No. The reporting date is 31st March 20X6. I will only do for 1 year, and because that is all I need. But outside this exam room, you can do it up to 20X8. But we are not interested in that here. So I would say subsequent measurement of 6% convertible loan notes component using EIR effective interest method up to 31 March 20X6. Okay, let me write the effective interest rate in full. Effective interest method. So that is the name of that method, but it's similar to what you learned under unwinding of discount of IS 37. It's similar. Vera, your hand is up. Please go ahead.
Okay, my question is, if we're solving for 20x6, why are you telling us to use 37,792? Are we not meant to use the one that is for that period, the present value for that period?
No. For which period? 31st March 20X6, right?
Yes.
But that is what we want to do in this working B. That is what we want to do now.
I mean, in your working A, your calculation, you were telling us the fair value, the liability we are using is 37,972 and not 40,000.
Vera, the working note we did in A, we are doing it as award date. Did you not see date on that A? Did you see a date on A? As award day are we doing that work?
It's at 1st April 20X5.
Which is the day the instrument was issued. Your interest is what is the value of the liability as at that date, so that you can remove that from the 40 million proceed to get the equity component. That should be our focus in split accounting in A. That was our focus, nothing more. We want to get, because our reporting day is 31st March 20X6, 6, we want to get what the value of the liability should be, amortized cost value of the liability. That is what we want to do in B now. And that is why you see the heading of what I'm doing in B says as at 31st March 2086. So here we are going to create a column, we say year. Create another column, we say opening balance. We create another column, we say finance cost. At what rate? Finance cost at what rate? At
8%.
8%, yes. And we will say interest paid, right? Interest paid. Then we will say closing balance, right? Okay. Let me wrap all of them. So let this column be A. Column B equals what? A multiplied by what? Multiplied by 8%. Column C, we equal the par amount. What do I mean by the par? The 40 multiplied by what? 6%.
6%.
Then the closing balance, which is column D, equal what? A plus B minus C. Right? Are we together? So all of them will be in dollar. Okay, I'm only interested in 1 year here. And that 1 year, let me just copy here, which is up to the end of 20x6. So remember, is the liability we want to subsequently measure. And that liability at the beginning of the year is how much? 37,792, based on what we did in the split accounting, the A part. That is 37,792. That is the opening balance. I'm sure we can all see that is the opening balance. I've explained each of this column for you. Your finance cost should be what? It should be the opening balance, which is column A, times what? 8%. That is 3023, right? 3023. Is that not? 3023. 3023. Interest paid is the 24. 40,000 times 24. So I can just pick it from this place. That is the interest paid of 24. And that takes us to the closing balance, which is A plus what? B minus C. That takes us to the closing balance. That takes us to where? The closing balance. That is where I will stop. That is where I will stop. That is where I will stop. If you are asking which figure goes to the SFP at the end of 20x6, if I ask you which figure goes to the SFP at the end of 20x6, see this closing balance, you can also call it amortized cost. The other name for it, that is what? So you've been hearing of amortized cost. That is amortized cost for you. So the figure that goes to the SFP is this, SFP, that is it, is this figure, is this figure here. Which figure goes to P&L as finance costs? How much? 3023, that is the figure that goes, yes, that is the figures that goes to where? P&L. So I will say P or L. What about the 24? It must have been paid. I can see two people, their hands are up. Hold on, I'm coming to you. But let me deal with this 24. This 24 must have been paid. it must have been paid because we are told it's paid in arrears, so it should be paid at the end of 20X6. Let's go back to our TB. Can we see 24 on the debit? Can you see 24 on the debit in the trial balance?
Yes.
Yes.
Interest payment.
Okay. You are seeing the 24 there, right? So it means
Yes.
when they paid it, they credited cash and they put it in interest payment account temporarily, which is the debit you are seeing, the TB. Now we have picked that debit now and we have used it. We have used it. We have used it. We have picked that debit and we have used it here. So that debit in the TB is no longer there. Because in arriving at our closing balance, we find the difference between 3023 and 24, which is what? 623. So if you look at the amount by which the opening balance changed to closing balance, if you find the difference between closing balance and the opening balance, is exactly that 623. Is exactly that 623. So what is causing the opening balance to change to closing balance is the difference between the 3023 and what? And 24 and 24. You may want to show the accounting entry for 3023, but it's not required. So I won't bother to show it, but I know the accounting entry very well. Okay, let me Temitope, your hand is up. Can you go ahead? After that, Ganesha.
Yes, sir. My question is, why are we using closing balance on the present value as of 2008, 20x8 as the opening balance in 20x6?
Where did you see closing balance
Hello,
at the
sir.
end of?
Can you hear me?
I can hear you, Temitope. Can you hear me too? Can you guys hear me?
Yeah,
Yes,
the
we can.
37792.
Yes.
Yeah, I can hear you now, sir. The
37792
37792 is the fair value of the liability components.
as
Yes.
our date. As our date.
The one you're using as opening balance as at
I
31st March
said that
2026.
that 37792 is the opening balance as our date. From working
Is from the first working we did is the total
you are getting
of
something wrong.
20. Okay, sir.
Can you listen?
Explain?
Listen.
I'm listening to you, sir.
The working we did in A, what is the heading of that working saying? Can you read it? Read it to me. What is the heading saying?
Can you please scroll down so that I can read it?
It's up. I've scrolled down. It's up. You can see it here. Line 52 up. Read
I can
what
only
you see
see
there
B.
for me.
I can only see B. Subsequent measurement of 6% convertible loan.
Your internet is not strong. Let me read it to you. Split accounting, in bracket, separation of the proceed into equity and liability component as at 1st April 20X5. The calculation we did there, the separation we did, is as at 1st April 20X5. The reason you are getting it twisted or confused is because we use in that calculation 24 20X6, 24 20X7, 24 20X8. Maybe that is why you are getting it twisted.
Maybe.
The calculation, separation we did there is as at 1st April 20X5. 37792 is the balance as at 1st April 20X5. Let me write it in front of you.
Okay. Now I get it.
Okay, Ganesha, can you go ahead? You can lower your hand, Tokwe. Ganesha, please go ahead. unmute yourself, Ganesha, and speak. Unmute yourself and speak, please. You are not speaking. We can't hear you. You are still on mute. You are on mute. Please unmute yourself. Okay, Ganesha will have to go ahead. If you are able to unmute yourself, then go ahead and speak. I will have to go ahead now. And because time is not on our side, we'll spend like 2 hours solving just one question. Ismail, your hand is up. Please unmute yourself and speak.
Hi, I have a question. For the figure for equity that you credited for the double entry, do we show it on our statement of financial position?
Yeah, you know, I've already taken it there. The credit leg has been taken there, as you can see. Can you see the statement of financial position?
Okay, yeah, I saw it. Okay.
That's
yeah.
the other component of equity. I've taken it there.
Okay.
Yeah.
Thank you.
Thank you. You can mute yourself and lower your hand. Okay, so we still have a long way to go. We have a long way to go, unfortunately. So permit me to continue. So we are done with this. But we need to be, I've told you we need to be very smart. We've got a figure now that should go to P or L, right? Which they have not considered in P or L. You know, they've not considered that figure in P or L. They've not considered it at all. So I should quickly go up. Requirement A. Requirement A. So I should come here and say finance costs on 6% loan note, right? Finance cost on 6% loan note, right? And I come here, you know it must be in jacket, and I come back here and link it there. 3023, yes. So you should be smart. That is, don't wait until you finish all the working note before you start coming to fix it. No, you should be smart. You should be smart. We are done with note 1. We are done with note 1. And we are done with working 1. Let's go to working 2. In working 2, that will relate to note 2. And I'm reading and you are listening.
Are we not to put in the liability component as well into the SFP?
Yeah. Okay, so in order not to waste time again, since we are trying to be smart, since we have got the amount of the liability that we go to the SFP, we should equally take it there straight. We should take it there straight. So I will quickly go to the SFP just to be smart. So 6% loan notes. So I will say working 2A. 2B, no, working 1B. Working 1B. And I quickly come down and link it. 38415. 38415. So you just have to be smart. This is working 1B. Referencing is not important in the exam. As long as you are linking it, the examiner understands what you are doing. Ganesha, your hand is still up. If you can unmute yourself now, you can speak. Otherwise, you can lower your hand. Esosa, please go ahead, Esosa.
Good morning, sir. All right, my question is the closing balance, which is carried to the SFP, the 38415, can we split it into current and non-current, or we just take everything to non-current?
It's entirely non-current. It's entirely non-current. It's entirely non-current. Because the principal is meant to be repaid at maturity, so it is entirely non-current. Is that understood?
Right. Yes.
It's not an amortizing loan. It's not a loan that repays principal every year. So it's only when you are dealing with a loan that repays principal every year that you'll be splitting the balance into current, non-current. But given that at maturity, the principal of 40 million will either be paid or converted to equity, it's entirely non-current. You can lower your hand. Let's read note 2. Note 2. Note 2 reads, and I say, that is non-current asset. I've told you PP will always be examined. There's nothing you can do. It will always be examined in this type of question. The directors decided to revalue the leased property at 66.3 million on 1st October 20X5. Wow, that is valuation in between the year. Valuation in between the year. If you come from April 20X5, April, May, June, July, August, September. So 6 months. Then from 1st October is 6 months in between. They said the director decided to revalue the leased property at 66.3 million. That is the revalued amount, right? That is the revalued amount. Okay. You guys have done IFRS 16. You know you were told, although they call it leased property here, this was a pre-IFRS 16 era. This question was set in 2016, and IFRS 16 leases was issued in that same year. ACC, started examining it in 2017, and the IFRS 16 itself became effective 1st January 2019. So if this were to be now, rather than calling it leased property, it would have been right of use asset. Under IFRS 16, right of use asset, you can use revaluation model for it. So don't say you can't use revaluation model. You can use revaluation model. So let's go ahead and read to the end. But in the TB, that lease property, okay, let me read it to the end before I talk. Triad code does not make an annual transfer from the revaluation surplus to retained earning, okay, to reflect the realization. Does not make. I'm sure we know what that means. Realization of the revaluation gain. However, the revaluation will give rise to deferred tax liability. Fantastic. At the company's tax rate of 20%. Okay. So don't forget, revaluation here we create deferred tax. The leased property is depreciated on a straight line basis. Plant and equipment at 15% per annum using the reducing balance method. No depreciation has been charged on any non-current asset for the year ended 31st March 20X6. Fantastic. So if you go back to the TB, there are two types of PPE there. We have the leased property. The cost is 75 million. Accumulated depreciation at the beginning is 15, right? 15. Then you also have plant and equipment. The cost is 72,100. And the accumulated depreciation at the beginning of the year is 28,100. So what I'm going to do now is I'm going to say working to leased property. Leased property. Remember, under IFRS 16, this will be referred to as right of use asset, although the amount may not be the same. Leased property. Property. Okay. Leased property. Okay, so I will say A. So I will say movement in leased property. Movement in leased property. Are we together? Okay, so here I'm going to, let me borrow from here. So we are going to say carrying amount, that is net book value at 1 April 20X5, right? That is at the beginning of the year. So how much is the cost? how much is the cost on the debit side?
75.
75.
Minus how much is the accumulated depreciation on the credit side? 15, right?
15.
At the beginning of. So I say equal 75 minus 15. That is 60.
15.
Remember, you have to first charge depreciation for the first 6 months because revaluation did not take place at the beginning of the year. It took place exactly 6 months. So I will first say depreciation for the first 6 months, right? And that will be, how do they say depreciation is charged? They say on straight line basis, right? What is the useful life?
25 years.
5 years.
Okay, so in front of it, you see 25 years, right? Original life. And they said depreciation is on straight line basis. So what I'm going to say is I will pick the original cost, 75, right? I will divide it by 25, right? That will give me the annual depreciation. Then I will now multiply that by 6 and divide it by 12, right? So equal minus, open a bracket, 75 divided by 25 times 6 divided by 12. That takes me to 1. That is 1.5, right?
Depreciation is 15%.
No, that is for plant and equipment. That is not for leased property.
Oh, okay.
So this is carrying amount on 1 October 20x5. Before what? Before revaluation. Immediately before revaluation. Yes. I will now leave a line. I will leave a line and say revalued amount at 1 October 20x what? 20x5. That is 66,300, right? 66,300. 66,300. Okay, so what will be our derived balancing figure, which is the revaluation gain? It's going to be the difference between the two, right? So revaluation gain. That will go to where? Revaluation reserve, right? That will go to revaluation reserve. So I will say the difference between 66,300 and this. We were not asked to do OCI, otherwise that figure will go to OCI, we know that. Okay, so if I put in red here, so this figure will go to P or L, right? P or L. So it's going to requirement A. This one will go to where? Revaluation reserve, right? Okay. We've not finished. Then we need to charge depreciation for the remaining 6 months. So I will say depreciation for the second 6 months of the year, right? Be careful the way you want to compute depreciation here. Be careful. You know, we must, now that we've revalued the assets, or at the very day we revalue the asset, we must know what the remaining useful lives are. Who knows what the remaining useful life is here? Or let me ask you, at the beginning of the year, 1st April 20x5, do you know the remaining useful life? Do you know the remaining useful life?
19.5.
22.
Wait, let me help you out.
15 years.
Hold on. 75,000 or million is the total cost. I say hold on, just go back on mute. 75 million is the useful life. I mean, it's the original cost. If you divide it by, okay, so original useful life is 25. We were now told at the beginning of the year, accumulated depreciation is 15. If you divide 75 by, go on mute, please. If you divide 75 by 25 years, it gives you 3,000. It means annual depreciation before evaluation is 3,000. Given the accumulated depreciation at the beginning of the year is 15, if you divide that 15 by that 3,000, are we together? If you divide that 15 by 3,000, what does it give to you? It gives you 5.
5 years.
At the beginning of the year, as at the end of 20x, 31st March 20x5, the asset has been depreciated for 5 years. That means at the beginning of the year, we have 20 years to go. If you take 5 out of 25, you are left with what? 20. You are left with 20. Now, if that is clear, you are left with 20. Now, we've depreciated for 6 months. That means 6 months have gone out of 20 years. We are left with 19 years and 6 months. 19 years and 6 months, which is 19.5 years. 19 point what? 19.5 years. So what I'm going to do here now is I will say 66,300 divided by 19.5. Please, I've explained to you how I got this 19.5. Then times 6 divided by what? 12. So I will come here and say equal minus the 66.3 here divided by 19.5, then multiply by 6 over 12. Right. That gives us 1.7. Then that becomes carrying amount at 31 March 20x6, right? That becomes the carrying amount at that date. So that carrying amount is how much? 64,400. So if you ask me which figure goes to the SFP, is this figure, right? SFP, that is the figure. That is the figure. That is the figure. The figures that goes to SFP is this. Then also 17 goes to P or L as well, right? So there are 2 figures here going to P or L. Yeah. Someone raised her hand up before, but the hand disappeared. I can't see the hand again. I can't see the hand again.
Okay.
Is there Esosa, then Stella? Esosa speak first, then followed by Stella.
Okay, I got what I wanted to ask that why we're taking that 1.5 to P or L, but remember that it's expected to take the 1.5, not just only the 1.17. So it's both together. It's going to P or L.
Well, we've calculated the depreciation one by one. The first 6 months is 1.5. The second 6 months is 1.7. Okay, Stella.
Okay, sir. I'm not clear on why we are saying the remaining useful life is 20 years, then later it dropped to 19.5, because I was thinking that what the useful life will be remaining is going to be 15 years.
No, you are wrong. Okay, look at it. I will do it here. Look at. I say look at the Excel. I will do it here. Annual depreciation. Annual depreciation. Do you agree it should be 75 divided by 25? Do you agree that?
Yes, sir.
Okay, that is 3,000, right? Okay. Do you know that at the beginning of the year, at accumulated dip at 1.4 x5. Do you know the accumulated depreciation is 15,000, right?
Yes, sir.
As given the question. Okay. If you want to know a number of years up to 1.4 x5 that asset has been used, what will you do? You will divide this 15 by this 3, then it gives you 5. That means as at 1.4 x5, the asset has been used for how many? 5 years. It's been used for 5 years. So remaining useful life at 1.4 x5 is the difference between original useful life of 25 and this 5 years. Do you agree with me? So it's 20 years as at first. So if you now take 6 months away from me, then you are left with 19.5. That's how we got it. I will not erase this. I will leave it in the Excel so that when it is sent to you, you can see it. So we are done with that. Let's do the plant and equipment so that we can quickly finish this work. There is still something, we are told there will be a deferred tax. So there will be a deferred tax on deferred tax liability here. So you must have known before today that whenever you revalue an asset, the tax authority in many jurisdictions, they do not reckon with revaluation. So if it gives rise to an upward revaluation, it means the carrying value of the asset will go up. As we have seen it here, it goes up from 58,500 to 66,300. It means the carrying value has gone up, but the tax base will remain unchanged. The tax base will not be impacted by that revaluation. That means a temporary difference has been created by the amount of what? Of the revaluation gain. So I would say deferred tax liability attributable to what? Revaluation gain. So that revaluation gain is the amount of taxable temporary difference. Is the same. So TTD, taxable temporary difference. So I will put it here, 7.8. Are we together? 7.8. That is 7.8, right? So I'm not going to the examiner said the tax rate. Okay, the tax rate is how many percent? The tax rate is 20%, right?
20%.
Tax rate is what? 20%, according to the examiner. So I will now say deferred. This will give rise to what? Deferred tax liability on revaluation. It's attributable to revaluation. So I'm going to say 7.8 multiplied by what? The 20%. That is 1560. Do you know the accounting entry for this? The accounting entry for this is ideally, wherever the revaluation, I didn't show the accounting entry for revaluation of 7.8, but if I had shown you the accounting entry, let me show you here. It's not required, you don't need to do it. You don't need to do it. It's not compulsory, but just let me show it out of my curiosity. Debit and credit. So that evaluation, the accounting entry will be to debit PP, which is leased property. PP, which is leased property. That means increase it. That is what we mean. Increase it by what? 7.8. And we have increased it, as you can see there. Then credit where? OCI. But we are not doing OCI. We are not asked to do OCI, right? It goes to revaluation reserve, which is where it's supposed to pass through OCI. But we are not, this question never says we should do OCI. So I take that amount to that place. Then, having done that, now that I've done my deferred tax, the accounting entry for deferred tax, let me borrow from here. The accounting entry for deferred tax is to debit what? Revaluation. That same revaluation that we credited is where we will debit. That is where it will go. Then we will now say credit deferred tax liability. Credit deferred tax liability. With how much? 1560. Then we will also debit revaluation with this amount. What does that tell you? That tells you that the net amount, I will now say the net amount in revaluation
Sorry for
reserve.
disturbing, sir. I don't know. Someone is just trying to remove me from the team.
Someone is trying to remove you. What is your name?
I just have to join again and again.
Are you sure it's someone that is removing you or it's your network?
No, it's not my network.
No one has the right.
Same thing happened to me as well.
No one has the right to. No.
So they actually can remove. They can remove someone.
I know, but who is that person removing now? Unless you are now on mute and they remove you, please. If you are on mute, nobody should remove anybody.
I am on mute, sir.
I was removed.
Admin, please don't remove anybody.
I don't know who removed me, but I have to come back in.
Some people say it's village people. I'm hearing some people saying it's village people. I don't know which village is that. Okay. You can see this question has taken time. So the net amount in revaluation reserve is it's going to be the 7.8 that we have there before minus what? 1,560. Yes, that is the net amount we will have there, which is going to be this. We say credit it with this and debit it with this. So take note, that is the net amount. That is the net amount. Take note of that. Now, what I will quickly do now, before I do C, is immediately I've told you should be smart for the examiner. We've got some figures here. Okay, let me finish note 2. Let's do plant and equipment. You know, there is another asset that we've not depreciated. That would be working theory, right? Let's do the plant and equipment. Then I will now tell you what to do. Oh, okay. I will tell you what to do. Plant and equipment. Okay, so let me just say that figure goes to revaluation reserve. Also, this one goes to revaluation reserve. So the net of all of them that is going to revaluation, the net of the two is this. The net of the two is this, which is 6240. So let's do plant and equipment. We will follow the same logic. We'll say carrying amount at the beginning, carrying amount at the beginning, carrying amount at the beginning of the year. So we say carrying amount at 1 April. Chicken, your hand is up. Please go ahead. Your hand is up. Please go ahead and speak. Your hand, you've disappeared again now. I don't know what to do. Carrying amount. How much is the cost for the plant and equipment, please? How much is
72,100.
Yes, 72,100. Sorry, my question, I closed it before. Let me open mine. So we have 72,100. Okay. 72,100 equals 72,100 minus, what is the accumulated depreciation at the beginning?
28,100.
28,100. That means the balance at the beginning is 44, right? Then there is nothing like revaluation as far as this one is concerned. And we are asked to use reducing balance, right, for depreciation at the rate of 15%, right? So I will now say depreciation, right? Depreciation at 15%, right? So it's going to be equal this minus multiplied by 15%, right? That is 66, right? Then the balance at the end is going to be what? Is going to be 37,400. That represents carrying amount at which date? At 31 March 20x6, right? 20x6. Yes.
Okay, that first line, shouldn't it be 20 April 20x5?
Okay, sorry, slip of hand. It's April 20x5. All right. Okay, so we've got another item that should go to PP, right?
Yes, PP and PL.
So let me just borrow. Okay. Let me highlight in red here. So this one goes to P or L, right? P or L. And this one goes to where? SFP. Okay, now that we are done with anything PP, let's go ahead. There are 3 depreciation, if you can see. There is a depreciation of 6 here, which is going to P or L. There is one of 17 here, which is going to P or L. There is one of 15 here, which is going to P or L. You can put all of them together and you can separate them, whichever you want. So I will say, the one.
I'm muted. Someone has muted you.
Nobody actually mutes them. People get muted.
Oh,
like
somebody.
I think someone on the call is acting naughty or something.
No, so if you do a little research,
Some of
you
the
will
new
find out
ones.
I'm sure it's not that person now.
Chicken, there's a chicken here.
If you do a little research, you would find out that speakers actually get muted when there are background noises. So it's not necessarily that someone is muting the speaker.
Yeah, so what we all need to do is the moment you speak, go back on mute. The moment you speak, go back on mute. That is what everybody should do. Speak and go back on mute. Speak and go back on mute. Then at that point in time, nobody will mute you and nobody will try to remove you. Okay, I should be the only one talking. It's only when you are given the permission to speak that you should unmute yourself. Depreciation on leased property, I think that is working what? That is working what? Working what? Yeah, that is working 2. Working 2A. 2A. So I will bring the 1.7 and the 1.5 together. This plus this. That should be 3.2, right? That should be 3.2. They have also said depreciation on what? On the depreciation on the plant and equipment. That is another figure.
Working on 3.
That is 6.6, right? That is 6.6. That is 6.6. That is 6.6. Okay. Okay. So working on 3. Yeah, we've done that. We've done that. So working 3, working 3, working 3, working 3. Okay, so then we did revaluation. We did revaluation. We've taken the tax effect of it. We've taken the tax effect of it. The deferred tax. We know the net amount that we go to the SFP is 6240. In order not to waste time and allow the system to time us out, let's quickly come and say revaluation reserve. That is working 2B, right? I did that in working 2B. And I should go and link that figure here. I should go and link that figure here, which is the 6240. 6240. Again, in order not to waste time and allow the system to time you out, we have deferred tax liability. We know there is another note that this will defer tax liability, but don't let us wait till then. Don't let us wait till then. We have working note 2B, where we already have a deferred tax. Maybe something else will come and change and increase it. But that which we have in that note, let's first bring it here. Let's first bring it here, which is the 1560. That is the deferred tax attributable to the revaluation. We should bring that one here, right? And you can see I've brought it here. I'm not saying that will be the only deferred tax liability we are going to have. We will have something else when we get to the question. But this one, we can't afford not to bring it here now, right? Then let me go to the third note. Let me go to the third note. So we are done with the notes that this will PPE.
So we didn't put the PPE figure in PPE or non-current assets.
Yeah, you are right. You are monitoring me there. You are monitoring me there, seriously. Okay, in order not to waste time. So again, to ensure that we are very smart for this examiner, because we want to pass, all we need is to be smart. So I would say working 2A, right? plus working note 3. Yes, that is where we are bringing both of them. So let me quickly go there. Working 2A. Yes, this 64,600. That's 64,600 plus the second one, which is 37,400. Yes, those are the two figures going to the PPE. 102. You can say we've brought 102 here now. We brought 102. So you are right. We should always be smart. Don't wait until you finish, because the system may time you out and you won't have the opportunity of bringing your solution here. You cannot allow that to happen. Be smart for the examiner. Tell the man that you are very smart. Tell the man that you came to Ivy League. Okay, let me quickly do working note 3. I mean, deal with note 3. Note 3. Note 3. Sorry. So note 3, what is it talking about? It says in September 20X5, the directors of Triage Code discovered a fraud. A fraud. We know note 2 deals with PPE. Note 3, what is it going to deal with? Let's continue. September is like middle, the end of the first 6 months, right? They discovered the fraud, and so what? In total, 700,000, which had been included as what? Receivable in the above trial balance, had been stolen by an employee. It's been stolen by an employee. Fantastic. 450 of these related to the year ended 31st March 20X5, which is the prior year. Interesting. The rest to the current year. Interesting. So out of that 700, 450 relates to prior year, and the balance should be 250, right? The balance should be, if you take 450 away from 700, that is 250. Okay. The balance relates to the current year. The directors are hopeful that 50% of the losses can be recovered from the company's insurer. What do we think? Should you impair? Should you write off everything, or you should think that because you please, you must go on mute. If you want to speak, raise your hand. I will call you. If you want to speak, just raise your hand. I will call you. If you want to speak, raise your hand. I will call you. Okay, someone raised their hand and their hand disappeared. I don't know. So, the balance of 250 is the only amount that will go to the current year, right? And the 450 will go to retain. Had it been the examiner asked us to do, had it been the examiner asked us to do statement of changes in equity, that 450 in the statement of changes in equity at the beginning of the year, that is where we are going to put it. We'll say retain at the beginning. We will now say effect of prior year error, 450 in jacket. We will now have adjusted restated figure, restated retain honey at 1st April 20X5. That is if the man had asked us to do statement of changes in equity, but he never asked us to do that. So I will go ahead without doing that. So, but they are now telling us story. The insurance, the claim from insurance company, should we recognize it? I need you guys to answer. I need hands up. I want you guys to, what do you think of that amount? They say half can be collected from the insurance. Martina, go ahead.
So I don't think it should be recognized because for it to be recognized, it has to be virtually certain.
Oh, for it to be recognized, it has to be virtually certain. Now that it's not virtually certain, what type of asset do you think this one is?
Is a
Asset that can be disclosed in the notes.
it should just be disclosed, I think.
Ah.
No, nothing. It's just hopeful now.
What is the name of that type of asset that you want to disclose? Assuming you are even allowed to disclose it.
I think contingent assets.
Contingent assets.
Contingent
assets. It's contingent asset. Contingent asset. So you are right. You are right. Others can lower their hand because you have said it all. Is not meant to be recognized. It should only be disclosed if it is probable. So that is IS 37. That is IS 37. So what I will do is I will just put a story here, working for. So I will say loss of, is it loss or embezzlement? That sounds like an embezzlement, Abby. Okay. Okay, loss of $700,000, right? $700,000 due to what? Fraud. Are we together? Are we together? Yes, due to fraud. Due to fraud. That is the name we should call it. So I'm going to quickly say charge to be the current year portion should be charged to where profit or loss of profit or loss for the year ended 31/3/6, right? And that figure is 250 based on what I've said before, right? 250. Prior year portion should be charged to retain the earning, which I'm going to work out separately. That is 450. It's the two of them that add up to the 700, right? It's the two of them that add up to the 700 that they mention here. Okay. I will now say the amount that can be recovered. Chicken, you raised your hand before, but it went off again. In case you are there, you can speak if you want to ask a question. The amount that can be recovered from the insurer is a contingent asset. That is all. Okay, so let me quickly take this one to pure hell. The one that goes to pure hell is this. Why this one goes to where? Retain earnings. So I will say retain earnings. Okay, let me quickly go back up there to the pure hell. So I will say loss of receivables due to what? Due to loss of inventory. Due to loss of what? Due to fraud, rather. Due to fraud. That is working for, right? So I will say equal minus. I come and link it up there. So that is 250. I will do retaining working notes separately, but that is when I'm done with that A, requirement A. And when I'm done, it shows that is when I'm done with the note. So we are done. Let's quickly read the last note so that we can finish
Sir,
up.
is it 250 or 450?
450 relates to prior year. That is what the question says.
Okay.
450 of this related to the year ended 31st March 20x5. That was prior year. So it's 450 that relate that we go to retain earning. Is that clear? Then let me do working 5, which talks to note 3. You remember for the students of Ivy League, I gave you the clue as how you should deal with the task note. Task note. The best way to deal with the task note is to create. So, and I'm going to, okay, but let me first read it. A provision of 2.7 million is required for current income tax on the profit for the year 31st March 20x6. That is current tax for the current year. One leg will go to the SFP, the other leg will go to P&L as an part of income tax expense. The balance on current tax in the trial balance is the under/over provision of tax for the previous year. By now, you guys should have been used to this type of notes. I've told you this note will always feature in this type of questions. So what we are seeing in the TB, there is a current tax in the TB. Is it on the debit or on the credit? How much is it? If you go there, is the last item on the TB, 700 on the debit, 700 on the debit. That is the figure, 700 on the debit. That figure, is it under or over? Is it under or over?
Under.
Once you see it on the debit, it's under. Once you see it on the debit, it's under. If you see it on the credit, it's over. So the examiner will not specifically tell you what it is, but you should figure it out. On the debit, it means it's under. And that under should be charged as part of the tax on the face of P&L of the current year. Then let's listen to what he's saying. He's still talking. In addition to the temporary difference relating to the information in note 2, we've already dealt with that. In addition to that, where we've already got tax of 1560. So he's saying in addition to that, at 31st March 20x6, the carrying amount of triage net assets are 12 million more than their tax base. That is another taxable temporary difference. Okay. That is another taxable temporary difference. So I will say taxation as usual. Taxation as usual. So I will say A current tax in the SFP. B deferred tax in profit or loss. Yeah, I would say C. No, deferred tax in the SFP. SFP in SFP. But that would be in addition to working 2B. In addition to working 2B. Then C. This is income tax in profit or loss. And the income tax in profit or loss, see the way I want to do it. Anything that is coming there as a charge, let me open this type of bracket. That is coming there as a charge, I will put it in jacket. Slash anything that is coming there as a credit, I will not put it in jacket. So I'm telling you so that when I do it, what I'm doing will resonate well with you. So what is coming here will consist of 3 components. The first one is current tax for the current year. Then you have under will always be in jackets. Under slash over should not be in jackets. Provision for tax in the prior year. Then the third one is movement. Movement in what? In deferred tax liability. We know that both of them are deferred tax liability. Movement in deferred tax liability. Okay, let's start. The current year for the current tax for the current year, according to the question, note 4 is 2.7 million. So 2.7 will be here, going to the SFP. And the other leg will come here in jacket, because 2.7 going to the SFP is a credit. The one coming here is a jacket of, so I would say equal minus, which is this same figure, but it must be in jacket. So anything I'm taking to P or L in jacket will be in jacket here. We all agree that what we see on the face of the TB, the last item, which is 700, is under, I would say minus 700. So it's going to P or L of the current year as a charge. Let's now deal with deferred tax. Let's deal with the deferred tax. The deferred tax in the SFP, in addition to working 2B. So I'm going to say taxable temporary difference times what? The tax rate. That is what we do. But how do we get the taxable temporary difference? How do we get it? The man says the carrying value of the asset, net asset, is higher than the tax base. By how much? By how much? 12 million, right? So
12 million.
So I will say 12 million. That is taxable temporary difference times the tax rate, which we have been told before is 20%, right? Is 20%. So I will say equal 12,000 times 20%. So I will put this, I will underline it twice. Yes, and I will equally plus I with the same amount. So it means the deferred tax in the SFP. The deferred tax in the SFP should be 2.4. That is what it means. The deferred tax, but that is in addition to the one we did in working 2. Please take note. That is in addition to the one we did in working 2. Please take note. So I've clearly put it there. Then the movement. We will now say deferred tax at the end of, for me, your hand is up. Please go ahead.
Sir, please, could you go over the 2 point again? The 12,000, where did we get it from?
For me, speak. We can't hear you.
Oh, sorry. Sir, can you hear me now? Hello?
Yes, we can hear you now.
Sir, the 12,000, the temporary tax difference of 12,000, please, where did we get it from? I thought they'd given us the deferred tax as 3.2 in the question.
3.2. Where did you say 3.2? That is in the TB. That is at the beginning of the year. That is at the beginning of the year, note 4.
Yes.
The deferred tax in the TB will always be at the beginning of the year. The 3.2 you see in the TB, it will always be at the beginning of the year, which is at the end of last year. But the one for the current year, you will always get the clue in the question. Are you with me?
I'm with you so far, sir. So how did we get 12,000, sir?
Is given. Taxable temporary difference is given in the question. In the last note, check the last note I read.
Okay, sir, I can see.
Have you seen it?
Yes, sir.
Okay, thank you for seeing it. Thank you for seeing it. Okay. So we've calculated the one in working 2B separately. So the deferred tax that we're supposed to have at the end, without considering the one we have in note 2, is 2.4. This one is saying is 2.4. Whereas at the beginning of the year, we have how much? 3.2. So if you look at it, is the deferred tax increasing or liability increasing or reducing? is reducing. Without considering the one we did in note 2 is reducing. Reduction in deferred tax liability means you should debit deferred tax liability and credit where P or L. You should credit P or L. So that is what it means. So I'm going to say 32, because I want it to be positive. I want it to be positive. I want it to be positive. So I will say, I will put 32 first. I want it to be, because it must be positive. 2, 4. I didn't put minus there. The accounting entry will be, the accounting entry is you are debiting deferred tax liability to reduce it from 32 to 400, and you are crediting pure L. And I've told you credit to pure L shouldn't be in jacket. I can see a lot of hands up. Vera, you are first. Okpeyemi, you are second, and Ramot, you are third. Vera, go ahead, please.
Okay, so I don't know how you got the 700 for under provision for
In
tax.
the prior year.
Yes.
It's in the TB trial balance. Check the trial balance they gave to us. The last item in that trial balance is that 700 on the debit side of the trial balance. Have you seen it? Have you seen it? Have you seen it now, Vera? Vera, please speak. You are mute. Have you seen it? It's there in the TB. And the last note, note 4, now tells us that that amount we are seeing there is under/over provision. And we told ourselves, or I told you that once you see it on the debit, it's under. If you see it on the credit, it's over. So, okay, you can lower your hand. Ramat.
Okay, sir. My question is, when we are considering this movement in deferred tax liability, are we not going to consider the deferred tax on the revaluation gain with the deferred tax at the end?
Okay, Ramat.
Yes, sir.
There are different ways of doing this. Since the movement created by that in deferred tax liability as a result of that revaluation has been separately taken care of. You know, we've taken care of it. We debit OCI, we debit revaluation reserve, and we credit deferred tax liability. And we've taken that deferred tax liability to the face of the SFP, waiting for the one we will do here separately. We've taken care of that. Please don't mingle that one with this. Mingling that with this will create problem for you. It's better you ignore that one and do this one separately. Is that understood?
Thank you, sir. Yes, thank you, sir.
You're welcome. Okay, so I will go to the face of my SFP now. Listen to what I want to do. I will go and put current tax of 27 there under current liability. I'll go and put deferred tax. You know, I already have deferred tax there. I'll go and add this one to it, 24. On the face of the P or L, which is what we are doing in A1, I will go and chart this 26. And that will be the end. That will be the end. So let me first deal with this. I will say current tax for the year. That is working note 5C, right? 5C. And I go and link that amount there straight, which is 26, right? 26. Are we together? Two six. Okay. Then I'll go to the face of the SFP. I already have a deferred tax liability there before, which I say working 2B. I will now say plus working 5B. So I go, what I have here before is a liability, and what I'm bringing here of 24 is equally liability. So 24. You can see it has increased to 3960, right? So my deferred tax liability has increased. Current tax payable, I'm going to have a figure of 27 here, coming from working what? Working note 5A, right? 5A. And that figure is yes, 27. It's 27, right? So we are done. The only thing that remains for us to finish now, is to do retain earning as a working note. To do retain earning as a working note. You know, we were given retain earning at the beginning. So check the way I'm going to do it. 6. I will say retained earnings. So watch carefully the way I'm going to do it. Retain earning as award date at 31 March 20x6, right? So I will now say retain. Okay. Now, I'll say retain earning at the beginning of the year. Retain earning at 1 April 20x5 per the question. How much is it per the question? Go to the TB, you will see it there. How much is it per the question?
35.
35, right? 35. See what I'm going to do. If we were to do statement of changes in equity, this is how it will appear. I will do it as if we are doing statement of changes in equity. I will now say effect of prior year error. Effect of prior year error. That is trade receivable due to fraud, right? So that is 450. You know where that 450 is coming from? This one, 450. So when I sum up like this, I'm going to have a line here. This now is restated retained earnings at 1 April 20x5. That is restated. Then the amount, Sosa, your hand is up. Please go ahead before I finish. Go ahead before I finish. Go ahead before I finish. Sosa, please go ahead before I finish. Your hand is up. You are on mute. Can you unmute yourself? Can you unmute yourself? Okay, I think due to network. Let me continue. Okay, go ahead now, please. Go ahead and speak. Okay, we cannot hear you. Let me continue. I think we are done with the A part. We are done with the A part. So I left too much space. Let me delete. So we are done with the A part. 14,327 is the answer to the A part. We found our mark there. Then that 14,327 is profit for the year. That is profit for the year, which has been adjusted, right? Adjusted. So let me quickly go down to finish the return I'm working on. So I will now say profit for the year. For the year. That is coming from A, right? A. So I will just bring it down here. We'll bring it down here. 14,327, right? 14,327. Then the two added together will now give us about 17,377. Are we together? That is returning at the end of the year. That is returning. Return earnings as 31 March 20x 6. Excuse me, let me put it. Okay. Speak, Esosa. I asked you to speak before, but you didn't speak. Speak now. Okay, I will command or connect this figure. We cannot hear you if you are. We can't hear you. I think your network is bad. We cannot hear you.
Okay,
your network is bad.
The 2.5.
The 2.5. Where did you see 2.5?
Can you hear me now?
Yes.
2.4 and
Where
3.2. Please kindly explain how you got it to come about the 2.6 or the movement in the fat tax liability, the 800.
The 2.4 here. The 2.4 here is the 2.4 that you have in line 108. Is the one you have in B line 108. The 3.2 here is the one you have in the TB. The 3.2 is the one you have in the TB on the credit side. I'm sure that is clear. You can go back. You can lower your hand. So let's go and bring this 17377 to the face of the SFP. So returning, that is working 6. Working 6. Yes. $17,377. I think we should be done with our SFP now. Oh, okay. We have trade receivable. You know, I didn't show something that I ought to have shown here. Let me show you something here. You know, we have been told the receivable we are seeing there does not, 700 is lost. Okay, let me show you the accounting entry. What would be the accounting entry for that? I didn't show you. I did not show you. I did not show you. Let me show you the accounting entry for that. So we will debit. We'll debit P or L. P or L, which is loss on receivable. With how much? With 250. We've done that already because we've taken care of that in A. We'll debit retain earnings already with the 450, this 450. Then we will credit receivable. We need to reduce trade receivable, right? Trade receivable. With how much? With 700, which is the summation of this and this. So our trade receivable must reduce accordingly. It must reduce accordingly. So let's go ahead back to our SFP. So trade receivable is what we have there. Trade receivables. So we'll say 28. 28. Is it not 28 that we have in the TB? Yeah, it's 28. Then minus that 700, which we have in, I can't remember the working note where we did, where I just went to now.
Working 4.
Working 4, thank you. Working 4. So that is working 4. So I would say 28, 28,000 minus. So I quickly go to that working 4. I quickly go to that working 4 and link that figure. You must link in the exam because that is part of what they want to test. Other current assets, we were given that in the TB, no adjustment. How much is the figure in the TB?
9,003.
93, no adjustment is affecting that. I put it there. No other item is coming to asset again. So let's sum up. Let's sum up. So I can delete all the extra spaces I created that I do not need. You don't need to delete in the exam. It's not compulsory. Nobody will penalize you. You leave it there. So my total asset is 138,600. Our equity, since we are done with returning, I will delete this for me. So the summation of the equity is 25,825, right? 25. Please, how much is the share capital? We've not brought in share capital.
50,000.
50 million.
Yeah.
So I need to change the formula to capture it from 22. That changes to 75,825, right? And because I'm using a single column, I'm not adding all the liabilities together. So don't we have current liabilities per the TB, right?
Yes.
Current liability in the TB is 17.7, right? Yes, there's current liability of 17.7. Can we all see it?
Yes.
Yes.
Yes, sir.
So no adjustment. So let's sum up. So the other side balance is balanced. So we are fine. We are fine. We are fine. So our SFP has balance. Our SFP has balance. So there is a C part of the question that we're asked to do. Let's quickly do that and go on break. Let's quickly do the C part and go on break. 15 minutes break. Our break will not be too long now. It will be 15 minutes. Let's quickly do the EPS. Sorry, give me a minute. A minute, please. Okay, I'm back. You guys have learned about calculation of earnings per share, both basic and diluted, right? And I'm sure when they taught you about diluted EPS, there are three things that could give rise to potential ordinary shares that you will use, that you will add to the existing shares to calculate diluted EPS. They must have told you about warrants, they must have told you about options, and they must have told you about this convertible. The only thing we have here is convertible, right? The only thing we have here is what? Convertible. Convertible. That is the only thing we have here. Convertible. Convertible. Okay. In the question originally, we have 50 million shares, equity share of $1 each. That is 50 million in units because the nominal value is $1. We now need to know how many additional shares are we going to have if these people convert. They've given us all the form info that we need to do that. When we calculate that and add it to that 50 million, it will give us the total number of shares. We already know that if they were to calculate if they were to calculate basic EPS, the profit that we use is 14,327. But the examiner says we should do what? We should not calculate basic EPS. He said we should not calculate basic EPS, right? So if we are not going to calculate basic EPS, then what we need to calculate is adjusted EPS. Then we need to look at, so I'm going to do a working 6 and 7 and 8. See my working 7. Working 7 is going to be adjusted, okay, I will say total number of shares to be used in calculating diluted EPS, diluted earnings per share, right? So this one will be in number now. And the number here, this will be in number. And the number here is going to be in thousands. It's going to be in number, which will be in thousand. Okay, number, which will be in thousand. So I will say number of shares for basic EPS. The number of shares for basic EPS is 50 million divided by the nominal value of 1, which will still be 50 million, right? 50 million. I'm sure you understand that. The number of potential ordinary shares from convertible. You know what I mean by convertible? The convertible loan stock or loan note. You know the value is $40 million, right? $40 million. If you guys can remember, it's $40 million we have there in the TB. That is the nominal value. You remember they now said, according to the note, if you go back to note 1, how many shares are they going to give for every $100 loan note if they convert? How many shares? I want 20. You to see it.
20 shares.
20.
So what will we, since that 20 is for every $100, we'll divide this place by 100. We now multiply it by 20. We divide it by 100, we multiply by 20. So I will say equal 40 divided by 100 times 20. That gives us 8 million. So the total number of shares we are using to compute diluted EPS is what? Is 58. Then let me say working 8. The profit we are going to use for diluted EPS, especially when it comes to convertible, is not going to be the same as the one we will use to calculate basic EPS. So I will say profit to be used in calculating diluted EPS. It's not going to be the same. So here I need in figures. I need, it's going to be in figures. So I will say profit after tax for basic EPS. You know, that is our profit for the year. Luckily, I brought it down from A, I brought it here. You know, this is our profit for the year. This 14,327 is our profit for the year. So I bring it there, 14,327. I will now make adjustments. All of you listen and listen good. Which adjustment am I going to make? Remember, we have charged the finance cost in P or L on this convertible, if you remember. The finance cost of 3023, if you can remember, that we calculated in working 1B is 3023. But you know, after we've charged it in P or L, it has after-tax effect. it has tax impact. So it is the after-tax effect that we are adding back. And the after-tax effect, so I will say after-tax effect of finance costs on what? On convertible. I think we did it in working 1B, right? Then times the tax rate. TR is tax rate. Okay, let me write it in full. Tax rate. No, times 1 minus the tax rate. 1 minus the tax rate. Okay, if I go to working 2, which is where we got that figure. Working 1B rather, which is where we got it. You know, is this 302? We've charged this in pure health. But why are we adding it back? Because if they convert, that amount will not come in as a finance cost again if they convert. So that is why we're adding it back. So we'll now multiply it by 1 minus the tax rate, which is 0.2, 20%. That gives us 2419. Wow, what a number, 2419. What a number. So the after-tax effect is 16,745. 16,745. So that is the profit we are using, 16,745. You've done all this in EPS. So we've got the two figures we need to calculate diluted EPS. Tokwe, let me finish first, then you ask your question. So let me come back to the main solution. The main solution. Diluted EPS is adjusted profit divided by what? Adjusted number of shares, right? Which is working 8 divided by working 7, right? Then we multiply by 100 because we want to get it in cents times 100. We want to get it in cents. So I go and say working 8, which I just did, divided by working 7, multiplied by 100. It's a figure, 29 cents in cents. In cents. Okay, so this cents, you can write cents at the back. Yeah, that is the end. That is the end. That is the end. That is the end of what we are asked to do. So EPS should be a bonus for you if it comes out. EPS should be a bonus for you if it comes out. Cents, 29 is more than 1 cent. Okay, Tokwe, your hand is up. Please go ahead. After that, for me, after that, Emmanuel. Tokwe, go ahead, please.
Okay, so I just want to be sure of the profit we are supposed to use now. Is it supposed to be profit before interest and tax, or profit after tax?
Tokwe. To calculate which profit do you think is available for distribution to the shareholders? Is it profit before tax or is profit after tax? Answer that question. Before you think of distributing dividend to shareholders, will you not have paid deducted tax? Answer that question.
Yeah, you would.
EPS is, we are looking at how much of the profit will be attributable to each shares. That is what we are saying. To calculate basic EPS, you use profit after tax. Profit after tax. If there is any preference shares that is even treated as an equity, and the dividend on it is shown in the statement of changes in equity as a deduction from retained earnings, you need to deduct that dividend. before you arrive at the profit to use. It is profit after tax minus dividend on preference shares treated as an equity. That is the profit you are going to use, divided by the weighted average number of shares in issue and ranking for dividend. If you are now calculating diluted EPS, you need to, if it comes to option, you are not adjusting profits. When that is potential ordinary share created that will arise as a result of exercising the right to convert option to share, that one doesn't have impact on profit. When it comes to warrant, it doesn't have impact on profit. But when it comes to convertible, especially convertible loan note or debenture, given that the finance cost has been charged in P&L, you need to now make adjustment for the post-tax effect of that. Post-tax effect of that. The reason we say you should adjust for post-tax effect is it is believed that your current tax will have been lower by the amount of interest you pay, by the amount of finance cost. That is why you will adjust for post-tax effect of that. Okay. I hope I've answered your question, Tokwe.
Yes, yes.
You can lower your hand for me.
So just a quick question. The diluted EPS, do we need to measure it in cents? Because the question, they didn't specify.
What did you say?
Do we need to times it by 100 to say 29 cents, or we can leave it as 0.29?
Okay, for me, in most cases, it is EPS is always calculated in the lowest of the currency in issue. If it were to be Nigeria, we will say multiply by the kobo, 100, which would be in kobo. In Nigeria, we calculate it in kobo. In US, it is cents if you are using US currency. So it is ideal. It is better expressed. It's not expressly stated in the standard, but that has been the practice. I hope that is clear.
Thank you. It's clear.
You're welcome. Emmanuel.
Thank you, sir.
Go ahead.
Okay, so I have a little worry, and I'd like you to just use your experience with how this exam is marked to throw light on this concern that I have. Okay, so I'm looking at how long it has taken us to solve this question, even though you had explained at the beginning that it's taking this time because we are doing it together, but based on you are very experienced in this. You've done this like 1 million times, so I'm judging by my own capability, so to speak. So in an exam, I don't know how easy it will be for a candidate like myself to be able to do all of this within the allotted time for this question. So my concern directly is how does my inability to balance my my SFP in this question, to what extent does it affect my being able to score any point in the third part of the question? Because clearly the components we have used to compute the diluted EPS are all generated from the SFP that we have done. So I'm looking at these items, and everything was derived in our calculation. So how does that play out regarding, with respect to the marking, the style of marking?
Okay, thank you very much. Let me quickly point out something to you. Number one, every total and subtotal in your SFP will not be marked. I will say that again. Every total and subtotal in your SFP will not be marked. And even in the first part of the question, what they are marking in the A part is not this total, it's the individual items you bring here. Are we together? But because this profit is used somewhere else, then you may have to get this one correctly. Because if you're unable to get this, it will affect something else, right? That is the second thing. Every total and subtotal in the SFP is not marked. So balancing your SFP is not your focus. It's never your focus. I can tell you, even when your SFP fails to balance in the exam, you can still get 19 over 20. You can get 19.5 over 20 because it shows that you just missed something. So being able to put the individual figure there is what matters to you. That should be your focus. That is number one. Number two, if you now do a simple mathematics, simple mathematics, you know, in the exam you have 3 hours, right? If you convert it to minutes, that is 180 minutes. Is that not? 180 minutes. Now, if you now say the first part of the question that carries 60 marks, sorry, section A, 30 marks, section B, 30 marks, right? And that is 60 now. Let's now say 180 minutes times 0.4. 0.4 is the balance of 40% that you are supposed to, the mark, 40 marks is what you have in section C that carries 2 marks. So that is 72 minutes, 72 minutes. If you divide that by 2, that will be 36 minutes. That means the maximum you should spend in solving this question is 36 minutes. Emmanuel, the maximum you should spend in solving this question is what? 36 minutes. Is doable. Is doable. 2 things will make this to be doable. You know why? Number one, you need to have solved a lot of questions. You should solve as many of these type of questions as possible so that when you enter the exam hall, you will just be smiling because there is nothing new you are likely to see there that you might not have seen in the several questions you have solved. That is number one. Number two, you need to get used to that platform, that ECC platform. So from today, between today and the day you will write your exam, go to that platform. There are many questions there. There are many resources there. Solve as many questions on that platform as possible so that you get used to it. Because experience has shown that many people that failed, they failed before. They failed not because they are not good. They don't know it, but because they are not smart enough to do these 2 things. So for you to pass these 2 things, solve as many questions as possible. It makes you to be comfortable. It makes you to know what to do the moment you start. Number 2, it makes you to then get used to the platform so that you'll be able to get used to that platform. In question A and section A and B, you are likely to save some time there. Time yourself in the exam. That is the overall thing. Time yourself. Don't waste too much time in section A. Don't waste too much time in section B. The time you are able to gain from section A and B, you could still allocate it to deal with this section C. If I were to do this question on my own, I won't spend more than 30 minutes. In 30 minutes, I will finish it because I have experience, like you said, and because I've solved several questions. I know what to do. I will go straight to do what I need to do. So to get to that position, do those things I've mentioned. I hope that answered your question, Emmanuel.
It does, sir. Thank you very much. Your calculation of the time is not, I don't know. You say 72 minutes. What time will you now allot for section A and B?
Okay, section A carries 30 marks. You know we have 180 in all. Section A carries 30 marks. So it carries 30 marks, which is like 30%, right? 180 minutes times 0.3, that is 54. 15 questions, 54 minutes. So if you divide it by 15, the maximum you should spend on every question there is 3.6. But I'm sure you should not even spend, there are some questions you can spend 2 minutes. Some questions you can spend 3 minutes. But on no account should you spend more than 3.6 minutes on every question. Is that clear?
It is, sir. Thank you very much.
So I'm sure you can, if you do there, on the average, you spend 33 minutes on every question, you save some time there. And that time you can use it in the C part of the question. Thank you. Opeyemi, your hand is up. Can you quickly go ahead and speak?
Yes, please. Thank you. So I wanted to ask if there is this is it adopted marking sort of thing that, because when I was playing for PM, I read that say if you solve the question and you need to use that figure for another question, if the answer is wrong, provided what you are doing in the second question is correct, with that wrong figure, you still get your correct answer. Say, for example, this earnings per share we've calculated. If for any reason you've calculated a wrong profit, but you use that profit correctly in calculating the earnings per share, will you get the mark as it is being said for PM?
Okay, you said you read it somewhere, right? Where did you read?
For PM. It's one of the examiners, whatever.
Okay, fantastic. The examiner is saying the right thing and is doing the right thing from what you have read, because he wants to test your principle, your understanding of what you are supposed to do. So if your profit after tax here is wrong, you did not get the figure we got, and it is still that same figure you link to your EPS calculation, the examiner should mark it right, because he knows that you know what you are doing. He knows that you know what you are doing. So you are right, and that is the best thing you should do. Yes. Okay, I can see Sheyi's hand up. Sheyi, you want to address us before we go for short break? Please, Sheyi, go ahead.
Thank you, Jamia. Can you hear me?
Yes, we can hear you.
All right. Good afternoon, everyone. Well, also depending on where you're joining from, whether it's Kenya or South Africa or Mauritius. Interestingly, we have about 18 countries that registered, or students from 18 countries that registered for the free revision. Jamie, if you don't mind, I just want to project one document. Is that
go ahead,
okay?
John. I will stop presenting. Yes, thank you.
Okay. All right. Sorry, just to... Okay, Jamie, can you see my screen?
I can see your screen. I can see your screen.
All right, thanks. So this won't take me more than 5 minutes, and then if you've got questions, maybe another 2, 3 minutes, and then you can go on your break. So as I said, welcome to Ivy League. I think about 40% of the people in this class are not the students that registered for the standard lectures. So you joined us effectively for this revision. We're based in Lagos, Nigeria. We are a platinum learning provider, and we've had that accreditation since 2017, clearly indicating, our commitment to excellence in a consistent manner over time. And then our tutors, when you look at their experience, you pick people like Jamil and several other tutors that we have at Ivy League. We are talking of over 300 years of combined lecturing experience. So these are people that have been doing it for several years. And that is also acknowledged by the markets. We have several students at Ivy League that are prize winners, particularly the national prizes. We are the consistent leader in that area, and even our tutors regularly pick up Tutor Excellence Award at the ACCA Award Night. And this is really because we have a clearly disciplined and outstanding tuition methodology. We fix our start date for lectures. We fix the end date. We know when revision should start. And every tutor, endeavors to stick to that. You don't come to classroom and there are no tutors. If that ever happens, it's really, really exceptional. And sometimes in a diet, it's less than 0.5% chance of that happening. So we run both online and face-to-face classes. Our online classes are marketed as live classes. We actually want students to be in class, ask relevant questions and all of that. But if for any reasons you are unable to attend a live class, we have some people, for example, joining typically from North America, whose time difference is very significant, and they often rely on the recorded lectures. So we also provide that service, which is not attracting any extra fee. For those in Lagos, Nigeria, they are also able to attend face-to-face classes for selected papers at our premises. It's selected papers at this time because of COVID-19 restrictions, but once everything has been eased, then we will be happy to offer face-to-face classes for all papers, and that's likely to expand next diet. We also offer Oxford Brookes project mentoring for those interested in the BSc in Applied Accounting. We provide lectures for CFA exams as well. That's a separate product line. If you are interested in it, or you know someone that is interested in it, please contact us. Same thing for ACCA diploma in IFRS, and obviously revision classes such as the one you are attending now, and marked mock exams. For next session, specifically for ACCA, we will be starting July 10th. For those that want to write September exams, both online classes and face-to-face. These classes are intensive classes. So they are typically for 7 to 8 weeks, to prepare students for such. So we typically advise that students have already taken full lectures, or you are self-studying and you are really self-studying, and you are not doing it for the first time without adequate self-study. But we also see students who believe that with the 8 weeks intensive, they are good enough to go for the exams, and some actually do pass. But for standard lectures, which is for December exams, that will start July 17th, the weekend just before release of results. OBE Open Day, which is Oxford Brookes Project Mentoring Open Day, will be August 1st. And our fees are highly affordable. For all that we give, we remain very competitive and affordable in terms of our pricing. Please, we will expect feedback from you. You can drop your feedback on the WhatsApp groups that have been created for the respective papers. What did we do well? What did you enjoy? What can we improve on for subsequent free revisions? You can contact us through any of the following, our phone numbers, our website, our email, and our social media pages are all available. So thank you very much. Just thought to share a little story with you about Ivy League, and then also our dates for next session. I don't know if there are any questions for me.
Sorry, when you say your fees are highly affordable, how much more or less are we looking at?
Okay, so the average price for a paper at Ivy League is in the range of $75, right? So depending on where you are, you can translate that. If you compare that to a comparable platinum ALP in the UK, I'm sure you know that's in multiples than what we have. So, but the average fee is about $75. Professional level papers, somewhere for one paper is in the range of about $100. I hope that answers your question. Any other question?
Sorry, it does answer my question, but what does it include?
Okay, so when you pay for a standard class, yes, please, just 1 second. When you pay for a standard class, you get access to lectures for 12 weekends, right? 12 weekends. That's typically 48 hours to 52 hours of lectures. So having done that for 12 weekends, then you also get access to 6 weekends of revision. So this revision class you are attending today is the final revision, after the last sets of revision in the past 4 weeks. that have taken place. That also gives you access to a mock exam that is marked as long as you submit it within the deadline and based on, our submission platforms and instructions. Yeah, pretty much. And then resources. Once you are set up on our Teams, which is our virtual learning environment, every student has a classroom. You have your class material folders therein. Once the tutor is done with the lectures at the end of the day, the materials are dropped therein. Some pre-recorded lectures are also in the class material folder. So all that is available to students who register for standard lectures. For the intensive lectures, the price is about $50, which is the one I said is 8 weeks, and you are pretty much entitled to basically the same thing, just that the duration of that program is shorter than the standard lectures. So is that fine?
Yes, it's fine. Thank you so much.
You're welcome. Yes, someone wanted to ask a question.
It's not really a question, sir, but I actually want to address a concern, and I don't want to say it here. I need somebody that will listen to me, and I'll say what I want to say. So I don't know who to contact.
Okay, Ayobami, thank you very much. You can contact me. You can as well contact Jamil. My screen is still on, so I will just put my number here. So you can just WhatsApp me or call me, right?
Okay,
Any other question?
I appreciate it.
Thanks. Yeah. All right, looks like we're good. Thank you very much for your time. Enjoy the rest of the day. Bye-bye. Jamil, thanks.
Okay, thank you, Shay. Thank you all for listening. What we'll do now is to go on break. I can see we've really spent a lot of time. What you should do is, let's just take like 15 minutes, no more than that. Go on break, then we come back. When we come back, the questions I sent to you, I sent you a question on group as well, and I sent you questions like objective test question on 3 different areas: IS8, IFRS, IS10, and financial instrument. Maybe I will want to start from those standards, see how far we can go about them. I'm afraid of eating into the time of my colleague. And I'm equally afraid it may not be possible to do the group question there from the look of things if I'm going to vacate the class for him to join. But let's reflect on that. Let's break now. We'll come back by in 15 minutes time. This is 12:43 according to Nigeria time. If we add 15 minutes to that, that means we should be able to meet by 12:58. 12:58 Nigerian time. Thank you. So we're on break now. Thank you. Or let's say we meet by 1 o'clock. 1 o'clock Nigeria time. So that may be a different time for you depending on the time zone in your location. Thank you.
Okay, Mr. Jami, sorry, while they're on break, can I see that part of the solution on diluted EPS, the cost saving?
Okay, let me share for you.
Mr. Jamil,
Yes.
will you share your with us?
Yes, since I want to believe all of you are in the group WhatsApp, and they have your email as well. The school admin will send you everything. Everything we are using today will be sent to you. Thank you.
Okay, thank you.
Thank you.
Admin, you may want to stop the recording now because we've done like 1 hour, 3 hours plus. You may want to stop and start again when we meet. So that it won't be too long, admin.